Uber grants all its UK drivers workers' rights, including minimum wage and vacation pay, in a first for the ride-hailing company. Good morning, everybody. It's just coming up to 8 o'clock here in London, just coming up to the start of the European equity trading session. You can see the futures pointing to the downside. So we are expecting to see a little bit of a loss, perhaps, but not great moves. And we are waiting for the Fed. We spent the last hour really talking about the Fed from various angles with our colleague Mark Cudmore over on the Markets Live blog. What will we hear about the dots? What will we hear about supplementary leverage ratios? All of that could set the tone for risk assets, could set the tone for bond markets and bond yields, of course, as we go through the overnight period. So we'll certainly be focusing on that much later in our European day. So as European equity markets open, we're waiting for that, really, waiting for the Fed. In the run-up to that, we do see a little bit of weakness coming through. US futures pointing just a touch to the downside. NASDAQ futures down around 0.1%. We see the FTSE 100 down around 0.2%. The IBEX down by a similar margin. But overall, these European equity markets, then the CAC moving to the downside just a little. So we're down by just 0.1% or so on the Stoxx 600. Now let's continue to focus in on that Fed meeting, turning our attention to what we expect from the Fed. Treasury yields are back up above 1.6% and creeping higher along with inflation expectations, which are at a 12-year high. While Fed Chair Jerome Powell has promised to maintain aggressive support for the US economy, the central bank's quarterly forecasts will show how many of his colleagues share his commitment. We spoke with former bond king Bill Gross. He expects US inflation to accelerate to a pace of 3 to 4% in the coming months.
Inflation, currently below 2% now, is not going to be below 2% in the next few months. I see a 3 to 4% number ahead of us.
Joining us now is Mike Bell, JP Morgan Asset Management Global Markets Strategist. Really good to speak to you then, Mike. And we were just hearing there from Bill Gross. He says in the coming months, you might see 3–4% inflation in the US. Could you see it getting as high as 4? Is that on the sort of Wall Street radar, do you think?
I think that's possible, but I think the key question that everyone's asking is how sustained is it going to be? And our base case is that it's not going to be that sustained, right? So we think that you're going to get this pickup because of the base effects. Obviously, the oil price is a lot higher than it was a year ago. And then we're going to see inflation come back down so that over the next few years, inflation may be slightly above target, but probably somewhere in that kind of 2 to 2.5% range.
How high do you think the Fed would feel comfortable forecasting inflation and yet not forecasting any rate rises? I suppose that goes to the heart of what their new tolerance for higher than 2% inflation is.
Yeah, I mean, I think that the Fed are going to be predominantly focused actually on what's going on with employment and then whether that does lead. I think if we get to full employment, and it could be that we get there much quicker than we have in past cycles, and we've got inflation that is above 2% and looks like it's going to stay there, then I think they would start to gradually put interest rates up. I don't think the Fed are going to be overly worried if we see inflation that's in that 2 to 2.5% range over the next few years, because we obviously undershot for several years, and it's explicit that they want to overshoot to make up for some of that.
Yes, I just wonder how much they'll be comfortable with anticipating an overshoot. I wonder what you expect to see in the dots then, Mike, when we look at that dot plot, much poured over, the most famous scatter chart, I suppose, in financial markets. What do you expect to see in that? Will we see the median dot moving higher?
I think that's a close call. It could do. The market's obviously moved to price 2 hikes now for 2023. That's maybe getting a little bit ahead of itself, but it's certainly possible that we could see 1 hike come through in 2023. I mean, they've obviously got a taper. That's going to take them the best part of the year. We assume they don't start that until sort of the beginning of next year. So then that puts you into 2023. And I think it ultimately comes down to the speed at which the labour market recovers. When you look at the jobs that have been lost so far, about 3.5 million of them are in the leisure and hospitality sector. So those could come back a lot quicker than normal. If that's what we see, then it's possible that we do get a Fed rate hike in 2023.
What would you expect the Fed to say, or how would you expect the Fed to account for the large amount of fiscal stimulus that we've already seen agreed in the US, Mike? How is that going to factor in there or be evidenced in their thinking?
Well, I think they'll be sort of happy enough with what's happened in bond markets so far, because it's just pricing in the fact that we're going to get growth that's really going to boom. If you think the consensus is that we're going to see growth this year of about 7% now that we've got this big fiscal stimulus, that seems in the right ballpark to me, given that we've got pent-up household savings of about 8% of GDP, and then this stimulus, which is about another 9% of GDP. Obviously, it's not a one-for-one multiplier, but to come up with a growth rate, therefore, in the region of 7% seems pretty reasonable. And so on the back of that, the fact that we've still got negative real yields, bond yields have obviously moved higher, but the bulk of that has come in the form of higher inflation expectations. And the markets behave very well, so that the equity market has digested that move up in bond yields. You've seen the cheaper stuff go up. You've seen the more expensive stuff broadly going sideways since September. So I think the Fed overall, looking at where they are today compared with where we were a year ago when, remember, inflation expectations were sub 1%, the Fed will be pretty happy, I think.
The Fed will be pretty happy. What do you expect? So we're at 1.63% on the US 10-year yield right now. Mike, what are you assuming that gets to?
I think it's reasonable to expect that real yields can go to about 0. I'd say that can push us up, maybe by the end of the year, towards around 2% on the US 10-year, with potential for it to go a little bit higher than that beyond that. But I think basically the direction of travel is going to continue, but it probably, A, won't be in a straight line, and B, I think it's not going to be at the same pace that we've seen, because over the last year we've seen this very rapid repricing in inflation expectations as we went from being concerned about a disinflationary bust to now reopening, and with that a boom in growth. But I think a lot of that repricing has taken place. So from here, it's a slower and probably not in a straight line move higher.
Slower, not in a straight line, but still moves higher. Mike, thanks very much. Stay with us. Mike Bell, JP Morgan Asset Management Global Market Strategist. He stays with us on the programme. Coming up, an AstraZeneca U-turn perhaps. Macron and Draghi say they could resume using the vaccine if the EMA advises that it is safe to do so. We will bring you the details next. This is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse. Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP. But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds of a global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. 9 minutes into the European trading session this Wednesday morning. You can see things looking a little bit mixed. In fact, the Xetra DAX actually managing to claw its way into positive territory, and the other markets also fairly flat. Let's take a look at some of the stocks that are on the move this morning. Danny Berger joins us with a look at those. Danny.
And I have some of our biggest movers to the upside, starting with Hargreaves Lansdowne, saying that they see their view for the year modestly above what expectations are. They're seeing more turnover for equity trading, more clients interested in international and U.S. stocks. So those shares moving higher by more than 2.5%. BT Group, also one of the big gainers today, more than 3%. Ofcom's bidding for some of the UK spectrum has ended. EE, the mobile subsidiary of BT, was able to win some 5G spectrum for about $630 million. So those shares moving higher. Also looking today at BMW, another story of another automaker pivoting more severely towards EV. We saw VW gain yesterday on this. BMW also gaining, helped by an improved earnings picture as well. Finally, let's get a look on the macro view. FOMC today in focus, and you'll see that we're really just hanging tight here as well. You can see Bloomberg dollar spot up for another day. US 10-year firmly around 1.63%, and not a lot of movement from European stocks as a whole. Same thing for US futures as well. You get the idea that turnover is low. Everybody's sitting and waiting because really the FOMC is going to have a hard time pleasing everybody. So just waiting in the wings as of now, Anna.
Yeah, absolutely. Fed. That is what we are waiting for today, Danny. Thank you very much, Danny Berger, with the latest on some stocks on the move and indeed some macro themes we are keeping across. Now, there are hints that France and Italy are heading for an AstraZeneca U-turn. The Italian Prime Minister Mario Draghi and French President Emmanuel Macron said they could start using the vaccine once again if the European Medicines Agency says it's safe. The EU drug regulator has so far backed the vaccine, but is due to give a definitive new assessment tomorrow. Joining us now is Bloomberg's Maria Tadeo. Maria, are we going to see AstraZeneca back in use then across Europe?
Well, Anna, I think that if you listen to that press conference from the European Medicines Agency yesterday, there was a very clear hint that they still believe if you do a cost-benefit analysis, the benefits of that vaccine would outweigh the risks. Now, they did concede that there had been a number of incidents related to the blood clotting, related to the CVTs that were serious and did merit closer inspection. But again, really stress that point that overall, given that coronavirus is still very much present in Europe, the vaccine is a right way to go, and that they did not see or did not have any indication at this hour that it was a direct side effect of the AstraZeneca vaccine. Now, the investigation, as you know, that probe will come with a final review tomorrow, but we're already seeing a number of governments changing tune on that front, also saying, including Emmanuel Macron and Mario Draghi of France and Italy, that if tomorrow there is an all clear by the EMEA, they are ready to resume the use of AstraZeneca in their own respective countries.
Yeah, we've seen comments coming through from one UK minister this morning, the business secretary, saying that the European comments on the Astra vaccine are very unhelpful. We even heard from the EMA themselves yesterday that they were concerned what this would do to take-up rates of the AstraZeneca vaccine, or perhaps of vaccines more generally. What does this imply then, this delay, if it is just a delay, and then reintroduction? What does it imply for distribution in Europe? Can Europe still meet those targets?
Well, Anna, you know, that's a good point. And there's two things happening here at the same time. One is when you look at the distribution, we're looking at a suspension that went on for 4 days. You also have to factor, and this is really key and we need to stress it, that AstraZeneca in the European Union is not what it is to the United Kingdom. This is not the lead vaccine in Europe. That is still very much the Pfizer-BioNTech. And yesterday, the Commission said that Pfizer had agreed to accelerate 10 million vaccines so member states could fill potential shortfalls using Pfizer. So again, on the distribution, perhaps it's not that big a hit, but the problem here, of course, is reputational, whether or not we're going to see significant damage done to the AstraZeneca vaccine. We also know already that the take-up numbers compared to other vaccines is lower. So whether or not this becomes more of a reputational damage than actually hitting that distribution. And in terms of the targets, you know, the Commission is still saying that they believe they can get to something that looks like herd immunity by the end of the summer. And, you know, that's really the idea here. You know, we'll wait until the summer. In September, we'll be judged. If we do get to that point, the Commission will say, in fact, it was mission accomplished.
Okay, thanks very much. Maria Tadeo, yeah, keeping track of the rollout of vaccines across Europe. Mike Bell, JP Morgan Asset Management Global Market Strategist, is still with us. Mike, I wonder what you make of the delays in the vaccine rollout in Europe and whether that plays into your investment strategy. Do you see this as a good time to buy European assets? Because if we're moving more towards value and if yield curves are steepening, then maybe that plays well for some European stocks. Or has everybody had that thought already and it's too late for that trade?
Well, I mean, on your yield curve point, I think obviously the curve's been steepening more in the US. So our preference is for value in the financials in the US, because what we've seen is this very strong correlation that as bond yields have been going up, financials have been outperforming there. Whereas I think the curve's going to steepen to a lesser extent in Europe. In terms of the vaccine rollout, I think eventually Europe will catch up with the rest of the world. So there is a story there. But when you look at equity market performance, you take the UK, where we're really rolling out the vaccine at a much quicker pace than they are in Europe, and yet the stock market has lagged Europe. It seems to me that perhaps there's a bit more value in the UK than there is in Europe at the moment, given that we're going to be reopened quicker than they are, and yet the stock market has somewhat lagged.
Yeah, and when we think about the factors we're investing around, and there's a lot of talk about that rotation, of course, into value stocks. And here I've got a chart that shows it's back to the US, but it shows how the S&P has outperformed a couple of different measures on the NASDAQ, the NASDAQ Composite and the NASDAQ 100 Stocks Index since the start of this year. But you make your point that maybe rotation is not the right word for it. Sure, we've seen underperformance by tech, but tech, interestingly enough, tech's still up year to date by these measures in the US.
Yeah, if you look at the big tech stocks in the US, so the sort of 6 largest tech stocks over there, then they're broadly flattish since September of last year. And then your financial stocks are up very, very strongly. Your energy stocks are up very, very strongly. So it's really been a pretty good scenario for equity markets in the things which got hit hard by COVID have been rallying very, very strongly. And the things which had done very well on the back of COVID have just broadly been going sideways. So I think that all in all, we're probably going to see a continuation of what's been happening since November, in that those financials, those value stocks continue to outperform, but probably with all the money on the sidelines, those tech stocks, they might still underperform, but I don't think they're going to go down a lot.
Yeah, and how would you expect that to change or develop as we start to see those big savings pots in US banks, in European banks, in UK banks being unlocked, or at least given more opportunity to be spent? Because of course there have been many people who've lost their jobs and they have not been saving, no doubt, during this period. But for those still in employment, there has been an opportunity to save. And how would you expect that wave of savings to hit markets and be spent?
Well, I think it's going to be spent across the board. If you look at it, actually, it's interesting that even the people who've lost their jobs, because they've been on furlough schemes in the UK, or they've been on pretty generous unemployment benefits in the US, many of them are in a much better position than they would normally be in a recession. But of course, it's the people who've kept their jobs that have really benefited. And there you see this big, big pickup in aggregate, we're talking about 8% in the US of excess household savings relative to what we saw in 2019. So I think as that gets deployed, it's going to be spent quite a lot of it on services. I think people are desperate to go out and eat out, see their friends. So I think restaurants, bars, these kind of things are going to boom. But of course, some of it is going to get spent online as well. And so as a result of that, I think you'll see this continued catch up in the stocks that got hit hard by COVID last year. But the big tech stocks will probably still do okay, albeit they probably underperform on the back that some of that pent-up savings will still get spent there.
Yeah, I think I've forgotten what restaurants are, Mike. I look forward to rediscovering the possibilities on the other sides of this. Mike Bell, thank you very much. JP Morgan Asset Management Global Market Strategist. Thank you for joining us. Coming up on the programme, Uber shifts its UK business model, giving drivers minimum wage for the first time. What this means for the future of the ride-hailing giant next. This is Bloomberg.
Expect that face-to-face learning is the ideal, but I don't think that we are ever going quite back to that. What we're seeing is more of this integration of the technology into the day-to-day. We have seen that schools have had this kind of trial by fire in terms of trying to reopen successfully, and that many schools have had to use a system of using different ideas around what it would take to reopen and then pivoting when those ideas did not work well, meaning that some have had to go back and had to close. And that's been a global challenge.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Welcome back to the European Market Open. 22 minutes into our European trading session, and actually trading water on the Xetra DAX this morning. The FTSE 100 losing a little bit of ground, down by around 0.2%. The CAC 40 also under pressure just a little. We're waiting for the Fed, though. That's the big picture story. That's the thing that dominates our outlook here in Europe. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Samsung is the latest tech giant to voice concerns about chip shortages spreading beyond the auto industry. The South Korean firm is warning of a serious imbalance in the semiconductor market. Samsung is one of the world's largest makers of chips and consumer electronics. It expects the crunch to affect its business next quarter. BMW says profitability will increase this year. The German luxury car maker is also joining rivals in targeting a steep rise in electric vehicle sales by the end of the decade. It wants about half of total sales to be electric by then. Facebook plans to start publishing an annual report detailing the company's impact on human rights. It's seeking to address criticism that its services are used to target oppressed groups around the world. The social network says it's also starting a new fund to pay for security and support for human rights activists and journalists. That's the Bloomberg Business Flash. Anna.
Laura, thank you very much. Laura writes in London. Back to one of our top stories, and Uber is making an historic change to the relationship it has with its drivers in the UK. From today, over 70,000 drivers in Britain will be reclassified as workers, entitling them to minimum wage and other benefits for the first time. It's a major shift in Uber's business model and is expected to send waves through the gig economy. Our tech editor, Nate Langson, joins me now for more details. Nate, a very good morning. So does this mean Uber now employs an additional 70,000 people in the UK? Talk us through this change.
No, it doesn't mean that. And I think that's one of the most interesting aspects to this, because there's something quite specific in UK law that distinguishes between an employee who would be entitled to employment rights, things like severance pay and things like that, and separately workers who are eligible for a living wage and holiday pay, but not necessarily the full range of benefits. And it is really quite specific to the UK and the UK legal system. There isn't an equivalent of this, for example, in the US, where Uber is also facing a lot of pressure from drivers and trade representatives to maybe do something similar to this.
Yeah, so in the UK we have this distinction then, which I think is not much known about, between workers and employees, which is important, and you draw attention to that. A lot of people ask what implications this will have for other parts of the sharing economy, but also what impact is this expected to have for Uber in other markets? Let's take that latter question then, Nate.
Yeah, I mean, so at the moment there is a big fight in the US, actually in Uber's home state in California, because of ballots that went ahead, I think it was last year, that reclassified drivers as independent contractors, and that's being challenged by drivers at the moment who want that changed. And then in Europe, we've seen in several markets there's a lot of pressure coming from lawmakers and regulators, excuse me, to basically put much more emphasis on the rights that people in the gig economy get from businesses. We're expecting to hear more about that later this year in terms of whether that could result in new legislation. And I think the other thing that's worth noting here is that the potential financial impact to Uber is quite low, in as much as the company is already paying above minimum wage to most of its drivers. On average, they're getting about 14 pounds an hour elsewhere in the country, and about 17 pounds an hour in London. So for those people, the minimum wage that's being offered here isn't going to be as significant as being offered the equivalent of 12% additional pay as a result of the holiday and vacation pay entitlement.
Nate, thank you so much. This is fascinating in the detail, isn't it, this story? Nate Langson, the Bloomberg Tech editor, thank you very much for joining us. And Uber's CEO, Dara Khosrowshahi, will be speaking to Bloomberg this evening. That conversation, 9 p.m. London time. Coming up on the programme, Going Green, France extends its lead as the world's biggest sovereign issuer of green bonds. That discussion coming up next. This is Bloomberg.
just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. Having the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
To a place like this and be able to break some stuff and release some tension without going to jail.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The Fed decides. As investors challenge the Fed's view on inflation, how will policymakers react? Coverage begins at 2 p.m. Wall Street time on Bloomberg Television.
Welcome back to the Market Open. We are 30 minutes into the European trading session and fairly flat on these European equity markets. Not so in London. The FTSE 100 is down by 0.3%, but it is really the autos and auto parts sector that outperforms. That's lifting the German index. Let's have a look at what's going on from a sector perspective. You can see autos and parts, the biggest gaining sector in the European equity session. That is doing well for Germany. That means that the Xetra DAX is outperforming. To the downside, we've got energy, you can see, and that's weighing on the London market. Travel and leisure also down by just over 1%, and there are no stocks, it seems, in positive territory within that space, whether that is travel or the gaming side of things on the leisure side. So that's what we see on these markets today. It is Fed Day, though, so that's the broad theme. Of course, we're building our way towards that Fed meeting. Let's get a Bloomberg First Word News update. For that, here's Laura Wright.
Thanks, Anna. France and Italy are hinting they are ready to resume handing out AstraZeneca's COVID-19 vaccine. The countries are waiting for the European Medicines Agency to give a definitive ruling on if the shot is safe. That won't come until tomorrow, but the initial guidance is encouraging. The regulator says the benefits far outweigh the risks. The US is setting expectations low for the Biden administration's first face-to-face meeting with Chinese officials. One point of tension is likely to be Taiwan. Its envoy to Washington told us she is confident the US will continue the work by the Trump administration to increase ties with the island.
This is a very critical time in our relationship with the United States. There is a lot happening in the geopolitical and geostrategic space. Taiwan does continue to be a force for good, an important security and economic partner to the United States, and we will continue to seek opportunities to work together.
Global news 24 hours a day on air and at Bloomberg. Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you very much. Laura Wright in London. Now, going green. France amassed its biggest ever green bond order book, extending its lead in the green bond space. The nation raised over $8 billion from the securities maturing in 2044. Crucially, investors bid around 50% more than for its first offering in 2017, reflecting the surge in appetite for green assets. Joining us now is Samantha Sutcliffe, UBS Head of Green and Sustainable Bonds. Samantha, good to speak to you then. So interesting to see France with this move. There's going to be increasing competition in this space, I imagine, from Italy, from Germany, and from the EU itself. Demand seems to outstrip supply right now. Will that continue to be the case?
Absolutely. I think, that this is a very interesting market at the moment. We do see exactly what you say, demand outstrips supply, and investors are very keen to get on board these transactions. I also think, sovereigns coming to the market is a really good sentiment and a good push for the private markets to, get involved as well. It's showing the private sector that, the state is behind this as well and doing what they can in terms of sustainable investments and pushing the envelope.
And do you prefer, what kind of time horizon do you like the bonds in this environment, or where are you seeing investors have the most appetite? Is it the long-dated end? Samantha, that you see a lot more interest?
It depends on the investor mandate behind. So that can vary, and it depends on where you are in the world, for sure. So we do see a mix. 20 years is fairly long in the green bond space at the moment, but, there is some flexibility, and going back to investors, being a little bit more flexible when it comes to investing in green financing, since they are looking for those assets to fill up their portfolios with.
We've heard a lot about the EU taxonomy, and I wonder if you could just weigh in with your thoughts about how crucial that is going to be for our better understanding of green investments in Europe, what kind of impact that has, and the timing around it.
Yeah, absolutely. I mean, the idea of the taxonomy is, of course, to create a definition around green activities and, establish that common language in the EU, which is, of course, very, very positive. At the same time, in terms of timing, we are waiting for the final delegated acts, as they are called, from the EU at the moment, and we'll see exactly what that entails when we expect this in April, so only a few weeks away. Depending on how stringent some of those criteria are, it can be a little bit more difficult for some green bonds in this instance to actually comply with the taxonomy. So it's going to be interesting to see how much of the feedback in the consultation end of last year that is actually taken on board.
Yeah, do you have a sense, Samantha, yet then as to what percentage of the existing green bonds market will comply and what percentage won't? Or maybe it's just too difficult to say at this point.
I mean, there are some studies out there for sure, with some estimations around it, and it is fairly quite low at this point. So, yeah, I mean, I think it can pose a bit of a challenge in the sense of issuers wanting to comply with the EU Green Bond Standard and the taxonomy, and that could actually then, be the effect that the volume may be a little bit lower. I don't think we should forget. Yeah, please.
Yeah, sorry, I was just going to say, the reason I asked this really is because I'm thinking about companies that are going through a transition from maybe being more polluting or producing products that are more polluting to being less so. And I wonder how the taxonomy will take account of those. Will the taxonomy allow them to sort of catch up, if you like, or transition, I suppose we're talking about here?
Yeah, I mean, the idea is that there are some components of transitional activities in the current taxonomy. Some countries have expressed that they are not enough to support their sort of sovereign journeys, if you will. So this is one voice that's being raised at the moment, and other countries are then opposing that a little bit and saying, no, let's focus on green within this document. But I think, you're definitely hitting the nail on the head here. What investors are looking for at the moment is that transitional story. So that is very much at the forefront of the conversation in the green markets.
Yeah, absolutely. A lot of people asking whether it's safe to be in that transitional space, or and indeed others asking if it's possible to invest in that transition. I wonder what broader impact the issuance of green bonds has for businesses, Samantha, because you make some interesting points in your notes that, sure, it can just sound like, a company goes to market, raises some money and promises to do good things for the environment. But to get to that point, certain alignments have to have happened within a corporation, or at least they can.
Absolutely. And I think this is a component or an aspect that gets forgotten sometimes. It's actually a corporate. In order to issue a green or sustainable bond, you do need to get the governance behind it. And that does mean that you can see positive cultural change within corporations. You do see sustainability strategies being either written from scratch or tightened, or you just see this sort of dynamics internally changing behavior, basically, which, in the long term has a massive impact in itself.
Okay, Samantha, thanks very much for joining us. Good to speak to you. Samantha Sutcliffe, UBS Head of Green and Sustainable Bonds. Really interesting to keep across that story, of course. Coming up on the programme, it is Fed Day. We've said it many times. Investors are waiting to see how long Jay Powell's message of patience will last. We dive back into the central bank conversation. That conversation coming up next. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
It is going to take another 3 to 4 months for COVAX to really pick up in the large amount of doses that they will get from all different manufacturers, again, because of vaccine nationalism, and now a new thing that has started, raw materials nationalism. So what the US, for example, has done, and I've sent this message to all the decision makers in the US, that please do not put a ban on critical raw materials that other global vaccine manufacturers need.
That was the CEO of the Serum Institute of India speaking to us as part of the Bloomberg Equality Summit, making a really interesting point with regards to vaccine rollout, vaccine nationalism and raw materials nationalism, just to make the point that the Bloomberg Equality Summit, from words to actions, currently taking place from the 16th to the 18th of March. Now let's turn our attention to the US. It is a big week for central bank decisions. Stocks and US futures are steady ahead of the key Federal Reserve meeting. Treasury yields are near the highest levels in over a year, and the dollar is stronger versus most major peers. Let's bring into the conversation then Laura Cooper, Bloomberg's Markets Live macro strategist. Good morning to you, Laura. We have some thoughts from Laura on our screen, things you have said this morning, I think, things you have written on the Markets Live blog this morning. Laura, give us your thoughts as we head towards the Fed.
Well, certainly markets are in this wait-and-see mode, and I do expect that really they're looking for clarity, particularly on the Fed's average inflation targeting. I think clearly we're going to see higher growth forecasts because we do have that fiscal stimulus coming through, but it's all about the inflation outlook. Will the Fed still have that 2% inflation range within their standard, their economic projections? And I do think that will
tell the markets whether they're dovish or whether they're hawkish. Now, I do think at this point, markets will also look to the dot plots for indications of really the Fed's thinking at this point. And then, of course, we have that SLR exemption at the end of the month. Will we get a decision on that, and how will markets react? I think really it's a wait and see period right now, and certainly I would expect fireworks today in some form.
Right, okay, well, that's interesting. I mean, yes, I've heard a lot of people, certainly some of your Markets Live colleagues, Mark earlier, but also others on the blog over the last 24 hours talking about how the Fed is perhaps a lot more interesting today than it has been in a little while. I know the question of the day you've been asking is linked, of course, to the Fed conversation. How would yields react to a change in the Fed's dot plot? This is, as I mentioned earlier, the most closely watched scatter chart in financial markets, and for that reason we talk about it quite a lot, don't we? And so how do you think yields are going to react then? I suppose first you need to suggest what kind of changes you're anticipating on that dot plot.
Well, and that's exactly the case. And I think it's important to note that it's not just the dots themselves that will be crucial, but it's also overlaid that with the inflation outlook. So if we do see that 2023 dot remain unchanged, the median estimate, and yet we see the Fed pencil in slightly higher inflation, that would be a dovish signal to markets. So I would expect the front end of the curve likely to rally somewhat. And that's because markets are pricing in about 3 rate hikes by the end of 2023, which does seem rather aggressive given current Fed guidance. Whereas on the other hand, if we do see those Fed members get a little bit more hawkish, we do see that median shift up to that 2023 hike, then potentially we could see markets ramp up those rate hike bets even further, and we could see the front end of the curve under pressure.
I have a couple of things I wanted to ask you, run by you, Laura, when it comes to the SLR. So this is the supplementary leverage ratio. Treasury is essentially exempted from the supplementary leverage ratio, something that the Fed granted to markets a little while ago. The exemption runs out, if nothing is done, at the end of this month. And so that is why the markets are focused on it a lot. And I wonder if we have to get an answer on this today. Is this something that the Fed has to tell us today, or could the Fed kick this down the road a little bit, and what would that do to markets? And I suppose the other question around this, is there evidence that this has been something that has been guiding markets? Did we see Treasury selling, Treasury negativity as a result of running up towards the end of this exemption?
Well, I certainly think that markets are prepared for some kind of decision today. Yes, the Fed does still have some wiggle room. That exemption doesn't expire until the end of the month, but really I think markets want some clarity today. So any disappointment on that front could see those yields climb even higher. And that's because markets, we're seeing strategists essentially potentially see 2 elements to this. So one, that could force some selling of those treasuries. It could see that tightening of swap spreads, because essentially this exemption has added an estimated $600 billion to bank balance sheets. Now, we do have other strategists who are saying, wait a second, it's not actually having that much of a material impact, so we wouldn't actually see that kind of position liquidation today. But I think for markets, it's all about clarity. They want some decision around that. So yes, while the average inflation targeting is crucial, I do think we do need some guidance from the Fed today.
A lot of moving parts then, it seems, as we go into this meeting. Laura, thank you very much for your insights. Laura Cooper, Bloomberg's Markets Live macro strategist. Coming up on the program, achieving unicorn status. We speak to Anne Bowden, the CEO and founder of Starling Bank, about its recent $1 billion valuation, growth targets for the company, and expanding across Europe. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
The economic impact of the pandemic has fallen disproportionately on women's shoulders. For the first time in history, for example, the economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
Well, women have had the most devastation, women and people of color, during this crisis. You know, we know women have left the labor force in droves. We know they're at home with this complete caregiving crisis, taking care of the young, taking care of the elderly. And so if we're going to have a full response and a swift response, we have to stop thinking as a world of gender equality as this nice thing to do when we get to it.
That was Santander Chair Anna Botín and Melinda Gates of the Gates Foundation speaking to Bloomberg about the disproportionate impact of the pandemic on women and minority groups. Lots more on equality, of course, in our programming, and we are holding that Equality Summit at this point. Let's turn to digital banking, and according to reports, Starling Bank recently secured more than £270 million of funding from a number of investors. This includes US asset manager Fidelity, the Qatar Investment Authority, and global investment firm Millennium Management. That's after the mobile app-focused lender was valued at more than $1 billion, achieving unicorn status. Joining us now is Anne Bowden, Starling Bank CEO and founder. Anne, very good to speak to you, and congratulations on the recent raising of funds. I wonder what this tells us about your plans for the future, about your plans to go public, perhaps. I know that you've talked about a path to IPO before, but what does that look like to you?
Yes, everybody asks us about the IPO, and in some time we're talking about probably the earliest, the end of 22, perhaps 2023. But this fundraising is a signal that we're bringing on board those investors that invest in pre-IPOs, that will actually continue to invest and buy in the IPO rather than selling. So this is a big landmark for us in bringing on board these very important investors.
Yes, indeed. And so you've pivoted in terms of your investor ownership. You know, you move away from just VCs and early stage investors to the sort of more mainstream. I'm interested to know, though, how you got your initial investment from Harold McPike in the first place. You know, for those watching and wondering how you go about getting your initial money, how does that kind of conversation start?
Well, I spent a long time trying to raise money without much success. Being a long-term corporate executive, deciding to quit her job in her 50s to start a new bank. People didn't believe it was possible. And my plan was quite audacious. You know, I wanted a new banking license, build the technology from scratch using the very, very best technology in the world, and build a business model that was fairer to customers. And I started going to VCs and various investors, and they all thought the plan was just too ambitious, wouldn't be achievable. So I took quite a long time to raise money until somebody that really understood the power of technology approached me and invested a substantial sum in our early days. And that gave me the funding I needed to build something that's very differentiated. Starling is much more of a tech company than a bank. We believe that tech can really enable, can really change lives, and that's proved the case in this pandemic.
And Dan, what are your plans then for expansion? Having secured this further money, you've talked about expansion across Europe. I think Ireland is the next leg of that journey. When do you expect to get that Irish license, and then from where do you go?
The situation at the moment is that we've raised capital to support further lending, which is going to be in the UK. But our plan is to obtain an Irish banking license and use that in order to passport into other European countries. We're working through that at the moment, but we don't plan to go to the States. Unlike some other new banks, we believe that Europe has lots of potential and provides the environment that we need in order to grow Starling.
Yeah, another difference between you maybe and other fintechs, Anne, is that you don't believe in growth at all costs. You have you like to keep an eye on profitability, and you like to be, by whatever measure, focused on profits. Is that something that you see continuing from here? How do you now measure yourselves?
We've been unit contribution positive, that is, each account making a profit for a couple of years now, and we broke into monthly profitability in October last year. And this is what you need. You need to be profitable and you need growth in order to obtain those valuations and build a great company. We are valued at £1.1 billion pre-money in this funding round, and that is signal that we have both the profitability and the growth and the potential to do something on a global scale.
And so you're talking a lot about those growth plans. You've moved to this space where you have a different set of investors, as we've mentioned, Anne. Do they have different expectations? Are they putting any limits on where you grow, or what have you told them about your growth plans?
I think they bought into the ambition. They bought into the fact that Starling is a grown-up fintech. You know, we've never been frivolous. We've always been building great tech that is robust and resilient, and a customer model that's really about caring about customers. And that is what business today is all about. It's about businesses that have mission and a passion for doing the right thing. And modern day investors buy into businesses that have picked up that the world has changed. You have to be responsible, you have to be tech, and you have to be offering something which is relevant to today's world.
Anne, thank you very much for joining us. Really good to get some time with you today. Anne Bowden, Starling Bank CEO and founder. Interesting to have that conversation around the fintech space. We'll keep across that story for you, of course. That is it for the European Market Open. Surveillance early edition is up next. European equity markets moving, well, in fact, European equity markets right now fairly mixed. The Xetra DAX doing better than the rest, and that has a lot to do with the auto sector, autos and parts moving to the upside, which obviously helps the German market. Elsewhere, we see the London market under pressure just a little bit. Oil prices actually just dipping even further. 68 handle on Brent, 68.18, weighs a little bit on some of those energy majors. That is it for the European Market Open. This is Bloomberg.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Inflation, currently below 2% now, is not going to be below 2% in the next few months. I see a 3 to 4% number ahead of us.
We're encouraging everybody to get vaccinated as soon as they are permitted to do so in their respective geographies.
And so if we're going to have a full response and a swift response, we have to stop thinking as a world of gender equality as this nice thing to do when we get to it.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London, Berlin, and New York on this Wednesday, March 17th. Our top stories today. The Fed looks at the future of the central bank's forecast today. Will tell us what policymakers think about the risk of inflation. Having second thoughts, France and Italy actually suggest they could do a U-turn on the AstraZeneca vaccine pause. And it's not just the auto industry. Samsung warns that impact of the global semiconductor shortage is spreading. Well, good morning, everyone. Happy Fed Day. Also, happy St. Patrick's Day. Now, we're just getting a little bit of breaking news out of Apple and antitrust probe that's been opened in France, and then the IEA. Now, this is interesting, the IEA, Kaylee and Matt, because the IEA sees no oil super cycle as supplies remain plentiful. This points to the fact that actually we couldn't possibly not see inflation because oil is shortage, or this goes back to the inflation expectations that we'll hear Jay Powell talk about a little bit later. Because if you look at the price of oil, if you see a huge recovery, then it actually means that the price of oil could shoot up if they're not pumping enough, and it seems that the IEA is now pushing back against that, Kaylee.
Yeah, well, Francine, the price of oil certainly not shooting up today. We are seeing Brent crude falling toward the lows of the session after that report. Right now, it's trading around $68 a barrel. But of course, today it is all about the Fed. Ahead of that Fed decision, we did see a mixed session over in Asia. Really, South Korean stocks, the underperformer, dragged down by Samsung as it warned about that semiconductor supply imbalance that you mentioned, Francine. In Europe, stocks are lower, down by 0.25% on the stock 600. It is a marginally stronger dollar story. This morning, the euro weaker against the dollar, sitting around 118.98 at this point. Here in the U.S., the S&P 500 broke a 5-day winning streak yesterday, and futures are just slightly lower with about 4.5 hours to go until the U.S. Open. The 10-year yield up about a basis point to 1.63%. The market really in a holding pattern ahead of that Federal Reserve decision come 2 p.m. Eastern time. They're not expected to move, but what will the dots look like? It's all about forward guidance, those growth forecasts, and anything Jerome Powell says about inflation. On the note of inflation, I would note that break-evens continue to inch higher. The 5-year break-even rate is now sitting at 2.66% or so. As for some stocks moving in pre-market trading early on, I want to focus on some retail or former retail favorites. Churchill Capital is down by about 4%. GameStop lower by 3.3%, could be lower for a third straight day. But Oncovia Therapeutics up 29% after getting mentioned on the penny stocks thread on Reddit. And another stock mentioned on Reddit, a pharma penny stock company, Savara Inc., is up by about 5.3% after rallying nearly 30% in yesterday's session, Matt.
All right, I want to take a look, Kaylee, at what's going on today. We just had the IEA report. We're going to get the EIA releasing its crude oil inventory report at 10:30 New York time. Then at 2 p.m. New York, we're going to get the FOMC rate decision, followed by a news conference from Fed Chair Jay Powell. This is the big one, folks. This is what we're all waiting for and watching in today's market. Of course, we're also going to have the general election in the Netherlands, and we'll be looking to see if the business-friendly incumbent continues his reign there. Markets are going to care. And I'm watching, Francine, BMW, because I have an interview with the CEO, Oliver Zipse, today just after noon, and the company said earlier that it sees its profit margin doubling this year as it joins rivals in stepping up its electric vehicle push. But they're still going to have demand for internal combustion engines.
Yeah, I'm also quite interested in the Netherlands story because I think if Mark Rutte becomes still once again the prime minister, he'll be the longest serving prime minister the country has ever had. Matt, in the last 5 minutes, we also have some news out of Apple. Now, I was reading at the margin about it yesterday, so I'm not an expert, but we did know that the Autorité des Marchés, basically the French regulator, was looking at them rolling out the new iOS 14 system. And this basically changes the way that they collect some of the data, which also infuriated some of the advertisers. So we'll have a look at Apple, but again, this is after proposed changes to the way it collects iPhone users' data did already spark outrage among online advertisers, Matt.
You'll have a look at that little French regulatory story on Apple when it comes out. You mentioned Mark Rutte and his reign as the Dutch PM. This is a chart of Dutch stocks since the last election, since he came into office. In white, you see the AEX out of Amsterdam. The other lines are the Euro Stoxx 50, the CAC 40, the FTSE MIB. The point being, Dutch stocks have really outperformed their other major European rivals here because, well, during Mark Rutte's reign. I wouldn't say because of, but I guess correlation is not cause. But it's interesting to note that they're outperforming, and the Dutch stock market has really taken over when it comes to trading in European shares as well. Since Brexit, we've seen the Netherlands market share in European share trading jump to the top, while London's market share, you can see from this great chart, has really fallen. Not quite been cut in half, but dropped off for sure. So it looks like maybe Amsterdam is the new choice for European traders, Fran.
Now, let's get to our top story. There are hints today that France and Italy are heading for a U-turn on the AstraZeneca vaccine. The Italian Prime Minister, Mario Draghi, and the French President, Emmanuel Macron, both now say they could start using the shot again if the European Medicines Agency says it's safe. Now, the EU regulator has so far backed the vaccine, but is due to give a definitive new assessment tomorrow. Now, let's get more with our reporter, Maria Tadeo in Brussels. Maria, I have to say, it's actually quite confusing because the EMA has never said that it was against it. It always said, actually, the benefits of the vaccine far outweighed the risk. So tomorrow, we're not expecting anything different, or are we?
Well, Francine, you're very right. In the space of a week, the European Medicines Agency said 3 times that it believed that the benefits of AstraZeneca presented a better benefit than any potential risks stemming from side effects. And yesterday, they repeated that message. You know, they were very clear. They said that right now there is no data to signal that those blood clots and the CVTs, which can be dangerous to public health, were a direct side effect of the vaccine. And they again insisted this is a cost-benefit analysis in the midst of a pandemic. At this point, it does seem the best way to tackle that is through the vaccine. But nonetheless, the probe continues, and we're expecting a final answer to that matter tomorrow. But nonetheless, if you look at the reaction today, this morning, from a number of governments, including the French and the Italian, they are prepping the grounds for a U-turn on that front, saying that if there is an all clear tomorrow by the EMEA, they're ready to resume taking up the AstraZeneca vaccine and continue the rollout as expected.
Hey, Maria, what does this imply for the distribution in Europe? Of course, it's been much slower than the UK and the US, and the question is whether they can even hit their targets.
Well, Matt, you know, there's 2 things happening here at the same time. One is, of course, we're looking at a suspension, but it only went on for 4 days. You also have to factor, and this is key, and we should stress it, that in the European Union, the AstraZeneca vaccine is not what it is in the UK. The lead vaccine here continues to be the Pfizer-BioNTech. And then yesterday, the Commission, by the way, said that it would receive an accelerated 10 million doses from Pfizer. So therefore, if you're running short of AstraZeneca, you could use that Pfizer to make up for it. So in terms of the distribution, the impact may be small, but the real question, and this is a real debate happening in Europe, is whether or not the reputational damage that may have been done to AstraZeneca will become even more problematic going forward. When you look at anecdotal evidence, AstraZeneca does have a problem compared to other vaccines when it comes to the take-up. So perhaps this episode may be a crisis too many and actually reinforce that mistrust, that perception that there is something wrong with the vaccine. Nonetheless, every regulator has said until now the benefits would outweigh the risk, and there is no factual evidence that there's any serious side effects to this vaccine. So again, it's more about the reputational than the distribution itself at this point.
Yeah, it seems like just a massive headache if people refuse to have that injection. Maria, thank you so much. Maria Tadeo in Brussels joining us with the very latest on the vaccine. Now, coming up next, of course, it's Fed Day. Rick Lacaille, State Street Global Advisors Global Chief Investment Officer. He'll weigh in on inflation and treasuries, and also stay with Bloomberg for our special coverage of the FOMC rate decision and press conference by Jay Powell. That all starts at 2 p.m. in New York, 6 p.m. in London, and this is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, it's Fed Day. Joining us to talk about inflation, some of the Bill Gross forecast on inflation, and maybe what we'll hear from Jay Powell. Rick Lacaille, Global Chief Investment Officer at State Street Global Advisors. Rick, good morning to you. I know there's going to be a lot for Jay Powell to try to unpack and basically try to say that his ultra easy monetary policy is fine despite the world picking up and despite some of these inflation forecasts rising. Can he counter the market by simply doing words?
Well, he can try. I mean, I think that he needs to, in my view, restate the AIT policy change that is a very important change and will allow the Fed to ride out what could be a temporary surge in inflation. If you look at industrial commodities, other indicators, we will see a little bit more inflation. I think, you know, the markets have repriced growth and inflation, but they're always way ahead of the current state of the economy. They're looking forward a long way. And I don't think they're too far away from where they should be. I don't think that they need talking down by the Fed. I think the Fed just needs to acknowledge that it's taking this long-term view of average inflation targeting. And that is the case because there are still strong, longer-run deflationary forces at play, despite the fact we've had all this fiscal and monetary stimulus.
So, Rick, we spoke to Bill Gross yesterday, and he said, look, he's expecting inflation to accelerate to 3.4%, and he was short treasuries. Would you be buying treasuries at these levels?
Not quite. We are a little bit underweight duration, but if we get the opportunity, if markets can stabilize and there's a decline in volatility, we might buy some, but I don't want to put a marker in the sand and saying there's a level. We prefer credit at the moment rather than making an outright duration bet. If we've got our risk budget, we'd rather spend it on credit than an outright duration play. And we do think that this sort of leveling out of the long end is going to help emerging markets that had a big sell-off, particularly in the local currency space.
Gross said, Rick, that he sees 3 to 4% inflation coming up due to all the stimulus in the system. And he said, 3 to 6 months of that could give Fed Chair Jay Powell a pause, make him a little bit nervous. Do you think that's a likely scenario?
I don't think he'll be nervous, but I mean, they're going to ingest that data, as Fed chairs always are. They're data hungry. They'll look at that data, but they need to make a decision whether that's an enduring change and whether there's a change in inflationary expectations, not just in the US, but elsewhere amongst both investors and consumers. And I think employment trends are strong, but labor markets are still weaker than some of the data suggest. So I think that the Fed will be mindful about the fact that we need to get employment broadening out, strengthening, even though we've got 3 to 4% inflation. That'll be, I think, top of mind.
Even with the labor markets the way it is, Rick, I look at the Taylor rule, and I'm not sure how much weight Jerome Powell puts into this, but if you see the chart, right now, the Taylor rule is implying a rate that should be closer to 2% than 0.25%. And clearly, the Fed isn't going to hike now or probably next year either. But when will the Fed have to hike? At some point, it's going to be difficult not to.
Well, again, I come back to that point about average inflation targeting. The policy change was there for a good reason. We've had a really long time where inflation's undershot. We've gone through an extraordinary pandemic. Now, it's not a pandemic that's taken out a lot of capacity, but the economy is changing an awful lot as a consequence of the pandemic. So I think a cautious approach, and caution means keeping easy policy, is warranted, because when you've got such big changes in the economy, you've had such a long period of disinflation or deflation. I think you've got to be aware that if you tighten too soon, particularly at a point where things are, frankly, pretty fragile globally, not just in the US, then you risk tipping back into bad territory from a deflation perspective.
Well, Deutsche Bank was out with a note yesterday saying they see inflation rates skewed, or inflation risk skewed to the upside, and that actually that could mean the 10-year Treasury could climb to 3% by year end. Do you think that is entirely out of the realm of possibility?
Well, people have called 3% before. I mean, if you jog back a few years, even pre-taper tantrum, people were saying, well, there'll be a normalization. If you remember, market watchers were seriously more benign in their outlook on inflation. But nevertheless, there were always some who said, look, we're storing up the potential for inflation. We could get to 3%. I wouldn't argue that that's impossible. I think it's perfectly possible if you look at long-run data to suggest real rates and a normal curve will put you at 3%. But we have gone through an extraordinary trauma in the economy, and we're still in the repair phase.
Rick, what does it mean for some of the equities you want to own, or actually that you want to sell?
Well, firstly, I mean, it's a pro-equity environment. I think valuations are stretched. There's no debate about that. But you've got strong sentiment, and you're going to have an earnings story this year, not just in the US, but elsewhere, that's very strong. So we like US equities. We still like some of the long-run growth stocks that we've stuck by. And they've been paying off quite nicely, actually. Even during this difficult period, many of the growth-related plays have worked well. And if you look at financials as well, obviously the steepening yield curves help the financials. But anything in the way of economic recovery that's going to keep at bay any credit losses is also very favorable in the financial sector. So I think this combination of very strong earnings growth, stretched valuations is always going to be worrying when you've got yields rising. But we're sticking with an overweight position, particularly in US equities.
Rick, thank you so much for today. Rick Lakai, their Global Chief Investment Officer at State Street Global Advisors. Now, coming up, an exclusive conversation on mortgages and inflation with the Wells Fargo Chief Executive, Charlie Scharf. That's at 12 p.m. in New York, 4 p.m. in London, and this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg European Surveillance, the early edition, the European edition. I don't even know. I need to go home and sleep for 10 hours. I'm Francine Lacqua in London, Matt Miller in Berlin, Katie Lyons in New York. Now let's get straight to the Bloomberg. First word news, and President Biden's tax plan will call for higher levies on corporations on wealthy Americans. Well, it will also include relief for middle-class households, including those in the $110,000 range for a year income. Now, a White House economic advisor says the president also wants to encourage companies to increase domestic investment. The U.S. intelligence community has concluded that China didn't try to change the outcome of the 2020 election. Now, that contradicts repeated assertions by the former President Trump and his allies. The agencies also found that Russian President Vladimir Putin ordered operations to hurt Joe Biden's chances. Here in the UK, Uber will reclassify all 70,000 of its drivers as workers, while a landmark court ruling last month made the drivers eligible for minimum pay, vacation pay, and other benefits. The ruling was a huge blow to Uber's business model in the UK. Other countries in the region also have been looking at the company. And Samsung has become the latest tech giant to express concerns about chip shortages spreading beyond the auto industry. Now, the South Korean company warns it is struggling from a serious imbalance in semiconductors globally. Samsung is one of the world's largest makers of chips and consumer electronics. It expects a crunch to affect its business next quarter. I have to say, I'm absolutely fascinated by the chip shortages. I can't say chip shortage, but I'm fascinated by it, Matt. And this could impact actually car makers. We've seen a political response, both in the US and in Europe, for a lot of these regions say, well, we need to actually be much more upfront and trying to bring some of these chip-making giants here so that we're more in control of the supply chain.
Yeah, in fact, we got a headline out just about 2.5 hours ago that car sales in Europe fell 20% to the lowest level since 2013. And that's not for lack of demand. That's because they simply don't have the supply due to that chip shortage. I'm also fascinated by the Uber story. I'm always interested in what's going on, Uber v. black cabs in London. Uber drivers, as far as I know, still won't need to pass the knowledge, right? They won't have to take that test that black cab drivers...
They have Google Maps.
No.
Or Waze,
yes.
whatever app.
I guess the kids don't need the knowledge.
But they will get minimum wage and be treated as employees. And it's so different, Francine, too, how they're going to be treated in the UK versus how they're going to be treated in California. It really is region by region, city by city, state by state, as it applies to these gig worker policies. Yeah. And here in New York, as soon as this spring, gig workers may be able to unionize. That's a proposal that could come up. So this is something that is far from over.
Yeah, and of course the question is whether the end consumer actually pays at the end of the day more, right? So if you're an Uber driver at the moment, I think it costs about 30% cheaper than a black cab driver for the same distance. If suddenly Uber has to pay some of the benefits, then does that mean that that journey becomes 20% more expensive? I don't know, but it's something I'm sure that analysts are looking at. Now, coming up on Bloomberg Technology, the Uber chief executive, Dara Khosrowshahi, that's at 5 p.m. in New York and 9 p.m. in London. I know we'll get a little bit of insight on whether he needs to change some of his drivers across the world to become employees. I know there's a big case also in Germany underway at the moment. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, the early edition. I'm Francine Lachman in London, Matt Miller in Berlin, Katie Lyons in New York. Now, there's quite a lot going on. St. Patrick's Day. Happy St. Patrick's Day to both of you. Of course, it's also Fed Day.
Happy St. Patrick's Day.
Tom Keene could not
Wait,
be
Kaylee's
more
not wearing any
excited.
green.
Don't pitch me, please.
Is that green?
No, there's
it's not
green on her screen behind her. We're fine.
That's true.
Move it along. Kaylee's on top of it as well. Matt, when you look at Jay Powell, I'm really looking forward to him trying to defend this ultra easy monetary policy as inflation expectations continue to rise.
Yeah, well, I mean, he might want it to be even easier, right? I mean, they're really focused on the labor market, and as good as everything else looks, the labor market still looks horrendous for millions and millions of Americans out of jobs. They're getting more assistance thanks to the $1.9 trillion stimulus package, but they still can't find a place to work. So the service industry has to pick up for Powell.
Kaylee, we also had some oil data, and actually the IEA saying they're not seeing a super cycle. What are you seeing in the markets?
Well, that is leading to weaker oil prices today, Francine. But I would say markets generally just kind of in a holding pattern ahead of that Fed decision. Right now, futures are just marginally moving. We're down about 0.2% on the NASDAQ 100. After 2 days of outperformance, that index may actually lag today, probably due to the fact that bond yields are inching higher by nearly 2 basis points on the 10-year, sitting at 1.637%. 4% right now ahead of that Fed decision later today. Of course, the bond market is going to be tuned into anything Jerome Powell has to say about inflation, of course, the growth forecast, and the beloved dot plot. What will it signal, 2023, or maybe a little sooner, maybe a little bit later? Of course, that's going to impact the FX and commodity markets as well. Right now, the dollar basically flat on the day, and gold actually higher for a third day, up about 0.25% right now. As for stocks moving in the pre-market, of course, that rotation looks like it may come back after tech leading for 2 days. It may actually lag. Apple is down by about 0.4% in pre-market. That may have a little something to do with the French probe, antitrust probe into iOS 14. And then you have oil stocks like Occidental up fractionally in pre-market trading, but two stocks moving a little bit more. Beyond Meat up about 4.24%, rebounding from a 6% loss yesterday. And Plug Power, this is a former retail favorite, down 21% in pre-market, absolutely plunging after some accounting mishaps, Matt.
You know what I'm watching? Yesterday, Eric Schatzker sat down with Bill Gross. He called him the erstwhile bond king, but I still think of him as the bond king. The most interesting piece of information I got from him, though, was on energy and MLPs. I'm actually using ETF Go to show this. We just searched through for ETFs that hold master limited partnerships in energy. Gross said he gets 13 to 14% dividends on these MLPs, and Warren Buffett's doing it too. So he's been riding the wave. He said it's the main thing he's focused on right now, and these have been returning year to date 25, 35, 40%. So definitely, Francine, I think a fascinating place to look for yield.
Yeah, I love that. I actually love that interview because at some point he also talks about GameStop and the fact that he made money. And a lot of people are saying, well, there you go. He's still got it. One-time bond king Bill Gross has stayed busy in retirement. Now he's back on Bloomberg sharing some of his best bets. They may surprise you.
I'm short the 10-year future, which is a 7-year, 6-year piece of paper. I'm short the long bond to a certain extent.
I also heard that you made a tidy sum trading GameStop in the January short squeeze. Tell me about that.
Sure. Well, I got in too early. I got in with options like a good Robinhood trader, I guess, and selling options, not buying options, selling calls. At around the $150, $200 level, it went to 400. There's an adage by Bernard Baruch way back when that said, sell to the sleeping point. Well, I wasn't selling to the sleeping point, but I did manage to overcome my insecurities and hold on and ride it all the way back down in terms of getting out. I'm back in. I'm still selling call options at 250 and 300. The volatility is super high, Eric, and that promotes an ability to make some money if
So you were effectively still short GameStop.
Yeah, not a lot. I mean,
through the options market, it's not like you've got a short position, borrow in a short position on in the cash market, but
well, it sort of is if the option comes due, if the expiration comes due, and you are forced to short shares. But right now the borrowing rate on shorted shares for GameStop is only 1.5%, which indicates no real squeeze or no real pressure. And so, with volatility at 400% annualized, it's really, you need a doubling and a doubling in order to start to lose money. And I think this is a perfect opportunity for option sellers, not buyers, to take advantage.
How much have you made on those trades so far?
Well, I was in the hole by about 10 million, but I'm about the same amount above ground.
Well, that was the PIMCO co-founder Bill Gross in conversation with Eric Schatzker. Now, to talk more about the markets, treasuries, and the Fed inflation is our Eddie van der Walt. He's Bloomberg MLive strategist. Eddie, great to speak to you as always. Are we going to get fireworks from the Fed today?
Thank you. I think so. I think one way or another. Nobody's really expecting this meeting to be live from a rates point of view, as colleague Cameron Kreese pointed out in his column on the Markets Live yesterday. But, whatever the Fed says at this point, whether it's about SLRs or whether it's just about their expected rates going forward, or about the growth rate of the economy, or about inflation, the bond market has absolutely got its eyes so closely on this meeting because there's so many unknowns in the world economy right now, and the bond market has shown that it will absolutely lead the equity market at the moment. So yeah, I think this is one of the most interesting Fed meetings that we've had in a while.
What is Jay Powell most concerned about, Eddie? Is it market pricing, or is he actually concerned about the growth of inflation?
Look, I think at the moment, I don't think inflation spooks the Fed at this point in time. I think the Fed is happy for a bit of an overshoot. The Fed is uncertain about whether an overshoot is going to be lasting, whether that overshoot will be with us for a while, or whether it is going to be transient. And I think that's the major question for the Fed. But I don't think that is enough to make the Fed act right now. I think if I was to guess what worries the Fed more than anything is that bond market volatility will trigger volatility in the equity markets, which will just undermine people's optimism going into what everybody's hoping will be a fantastic growth phase for the world economy. And I think for that reason, I think the Fed will be particularly cautious.
I'm still obsessed with Ray Dalio's LinkedIn post on Monday, and I wonder what you think of it. Cash is trash. He doesn't want anything dollar denominated, and he thinks Bitcoin and gold are great assets, although he wants to stick with the one central bank's trade. What was your reaction to Dalio's thoughts?
Yeah, look, this is not the first time Dalio used that phrase, cash is trash. He likes it. But look, I do think there's this difficulty for Dalio going forward. We've had, just the whole risk parity industry has done phenomenally well, in this long end bond downtrend, and I wonder whether that continues, and that is worrying for him. So it makes sense to want to diversify into things like Bitcoin and gold.
Eddie, he's still, this is the doomiest and gloomiest he's been. I mean, he says tax increases are going to be shocking and that the U.S. might impose capital controls to stop movement. What do you think about that?
Yeah. I don't, you know what, you do get a sense. So Dalio was silent for a number of years and did phenomenally well out of the world economy. And now he's starting to speak, but he is incredibly bearish for somebody who's done so well out of growth over the years. there is a sense in which you get a lot of older investors as they start speaking and talk more freely, sounding a little bit more bearish. I wonder if that's not what's happening with Dalio.
Well, Dalio may be bearish.
He'll forgive me, I'm sure.
I'm sure he will. Dalio may be bearish, but overwhelmingly investors seem to be bullish. The Bank of America Fund Manager survey that went out yesterday was titled, "It's Over," like peak capitulation. Is that true?
You know, it does. I think going into the next few months, I think it's hard not to be excited about global growth. People have been locked up in their houses for so long. People are suddenly going to be able to get out. They're going to go to nightclubs. They're going to book restaurants. You know, everything that I've been trying to book restaurants months in advance, everything's full, right? The places that are open or that are open are full. Trying to get a holiday. I think there's a lot of pent up demand. So it is hard not to be optimistic about the economy in the very short term. But you made a great point, Matt. You know, GDP growth can only go so fast. And we're coming off a really low base. Now, getting back to the level where we were will require phenomenal growth. And whether the world economy has the capacity to get us there, that's a different question. And we're seeing that sort of pressure in chip makers at the moment, where you know, people want to buy cars, but they can't get them.
They just can't get them. I want to go to Mauritius. I have had to change my holiday booking twice. That's because the flights keep getting canceled. But, you know, yesterday, Ann Mathias from Vanguard told me she thinks GDP growth is going to be the strongest since World War II. So a huge pickup in GDP. Eddie, thanks very much for joining us. Eddie Vandervalt there talking to us about the markets on this Fed day. Also, happy St. Patrick's Day. Eddie, coming up, BMW seeing EV deliveries up over 10 times in 2025. It's from a fairly low bar this year, but we're going to talk to the CEO. I'm very excited about this. Oliver Sipsa sits down with me via satellite, of course. Look for that interview in the close today. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get more on the Fed announcement today. The FOMC, all but certain to hold rates near zero and repeat its plan to keep buying bonds at the current monthly pace of $120 billion. Expectations of a strong recovery from the COVID-19 slump make the Fed's rate forecast a closer call. Well, let's discuss all of this with our international economics and policy correspondent, Michael McKee. Michael, the decision day is basically, it's almost a little bit too close to call, but what we're sure about is that Jay Powell will have to defend his ultra-loose monetary policy.
Yes, because the economy has picked up a lot, Fran. You know, they've been talking about the vaccines and the virus being the drivers of the economy, and the vaccination rate has picked up tremendously. And along with that has come a rise in forecasts from private sector economists. We have Goldman Sachs, for example, calling for 8% growth this year. The last time the Fed made a forecast, it was at 4.2%. And so if you look at the difference between the Bloomberg survey of economists, which the mean is 5.5% for the year, and the Fed's numbers, there's a big difference. And they're probably going to be raising their forecast today. And then the question becomes, what does that mean for inflation, for the outlook for interest rates? Obviously, they're not going to raise rates this year, but does it pull forward a rate move?
What did you think about Bill Gross's, 3 to 4% inflation? Saying we could see that spike isn't really, isn't going too far out there, but saying it holds for 12 months maybe, that could be out of consensus. Is transitory the current consensus, Mike?
Transitory is the current consensus, Matt, but with a big dollop of caution, because people really don't know what's going to happen with inflation in this circumstance, because we've not had a pandemic like this in the times that we've had good data. And you have, at this point, energy prices rising, and you'll have base effects, and so we will see prices go up. The question is, do they last, as you say? And the Fed's bet is that they don't, that they come back down again after about a year, and they've said that they want prices above 2%, between 2.5% for about a year before they start to move rates. The question is, are they going to be able to do that, or is it going to happen faster than they think?
Well, and that's the question when it comes to the $1.9 trillion in fiscal spending that is starting to pump its way through the economy. And Treasury Secretary Janet Yellen, when asked about that, continually says, even if it does lead to more inflation than expected, the Fed has the tools to fight it. How true is that? What is the Fed's actual capability to rein that in if it does materialize?
Well, we've seen, Kaylee, that they can do it. They've done it many times in the past. By raising interest rates, it cools the economy. The question is, can they get a soft landing out of it, or do they throw us back into recession? And that's what the market's going to worry about if we see inflation for too long. This is a complete experiment, because the Fed hasn't been here. Not only are we in a new situation with the pandemic, but the Fed's never had a policy like the one they do now. They've always been preemptive. They've always tried to get ahead of inflation. And at this point, they're going to wait. They're going to let inflation come and then bet that they can put the roadblock up when it starts to get too high. Their belief is inflation dynamics have changed. Globalization has changed the world of prices. And so they have time to be able to react. And that's going to be something that's going to be an interesting tug of war between the Fed and the markets over the next year as rates go up. Would the Fed blink, or are they really committed? Can they maintain their credibility?
But, Mike, it seems that actually more and more economists are saying, we'll get rampant, I don't know if it's rampant, but 3-4% inflation shorter term, but then by the end of the year, we're back below the central bank's expectations.
That's the thought, maybe roughly around the end of the year. It's really going to depend on shortages in the economy and how long it takes to work out supply chains once we get back into full swing, and hopefully that's sometime this summer, because the shortages are what's going to push up prices for things in the short run. The question is then, do we get into the Friedman-esque kind of inflation, where it's a monetary phenomenon, too much money chasing too few goods? Do we start to see people requesting raises? Now, again, not just globalization, but the lack of strong labor unions in the United States these days has kind of pushed down on the idea of massive wage increases across the board to keep up with inflation. So keep an eye on inflation expectations. If people start to believe that inflation is embedded, then the Fed's going to have a problem.
I'll tell you what, the Ford has a new electric SUV-ish vehicle called the Mach-E. Everybody wants it. Dealers are charging a $10,000 markup on this thing when they get them on the lot. I want a Ram TRX. It's got 710 horsepower with a supercharger and a 6.2-liter engine. They're charging a $20,000 markup. Do you think my boss would give me a raise if I tell him I need it to buy that truck?
I know your boss, and I don't think so, Matt. And he would point out that you probably can't park it in Berlin. But the situation with autos, I mean, you're talking about new experimental cars that are going to be more expensive, and then when they get produced in volume, the price will come down. The problem with autos is a supply chain problem that we're running into in other places, and that's the lack of chips. But that's something that people expect to go away as part of the transitory inflation. But nobody really knows because we've not been in this situation before.
I've just emailed the keeper of the Amex, actually, to ask for a raise on behalf of Matt Miller, all for research purposes.
You want a pickup truck too, right?
Can we all get one? I'm okay.
Brand needs a self-driving pickup.
Editor Mike McKee, yeah, or maybe just a push bike. Now, stay with Bloomberg. We'll have plenty more on the Fed, the FOMC rate decision, and press conference by Jay Powell. That starts at 2 p.m. in New York, 6 p.m. in London, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed decides. As investors challenge the Fed's view on inflation, how will policymakers react? Coverage begins at 2 p.m. Wall Street time on Bloomberg Television.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, Tom Keene, co-anchor of Bloomberg Surveillance, in the throes of St. Patrick's Day celebration, joins us now. It's also Fed Day, so actually it's probably the highlight of the quarter for him. Tom, you're looking at jobs, and of course everyone's looking at inflation. Good morning.
Yeah, I thought Michael McKee was brilliant there, really going back to the core fear of the conservatives, the inflationistas, which is Friedman-esque inflation. I thought Mike nailed that. I'm going to look at the jobs idea the chart here is what is not occurring in America. Mike alluded to this, as he always does. He's the expert. And that is wages have not come back to where they're concerned. To the left of the chart is the glory of 3% plus wage growth. Looking at ECI, which is a preferred metric, we've come back. It's been pretty good over the last number of years. But Francine, we're nowhere near the heart of the inflation matter, which is wage inflation.
Yeah, the dot plot. I can't tell whether you have the dot plot actually on your bow tie or whether you
yeah, the dots are here. This side is up right now. We're working on a custom dot plot chart right now. We hope to bring that to you on radio and television in the simulcast. Actually, we're working on that over in London. I mean, as you know, Hillary, Francine, started St. Patrick's Day 3 days early. We hope to get the dot plot chart. We'll do it in conversation with Glenn Hubbard of Columbia University. A perfect day to speak to Glenn Hubbard, given our fiscal excess. Lauren Sauer on the pandemic as well. And we are thrilled to have an extended conversation this morning with Mr. Hatsias of Goldman Sachs, the best of academic and market economics. We're going to do that today, right through to Caroline Hyde's Fed Show.
Yeah, I'm really looking forward to it. And of course, the improving outlook makes the Fed's rate forecast a little bit closer to call. Tom Keene there, co-anchor of Bloomberg Surveillance. Now, let's have a look at what else we're watching, because there's quite a lot going on. There's chip shortage, I think there's hearings and vaccines. Matt, what's on your radar?
Well, as I said at the top of the show, European car sales dropped 20% to the lowest level since 2013, which was like 50 years ago. That's, I think, really important because there just aren't enough cars on the lot. Alex Partners put together a chart showing how much was lost, or how much will be lost, I should say, in 2021 due to the chip shortage. And the biggest losses are coming out of China. The U.S. isn't going to suffer quite as badly. Kaylee, what are you watching?
Matt, I'm basically just watching the Fed. Everyone is today. But also there is a GameStop hearing on Capitol Hill at 10 a.m. Eastern Time, part 2 in the House Financial Services Committee. No Roaring Kitty or Vlad Tenev or Ken Griffin this time, but still something to watch as that saga continues, especially with a number of Reddit-related stocks on the move in pre-market trading this morning, Francine.
Oh, there's one. Well, I'm watching actually, the decision from a lot of countries to suspend the AstraZeneca vaccine. There's a brilliant piece on the Bloomberg terminal by our Ian Wishart saying this may be a crisis too far for the Commission. Now, stay with Bloomberg for our coverage of the FOMC rate decision and press conference by Jay Powell. That starts 2 p.m. in New York, 6 p.m. in London, and this is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It is interest rates. It's that chronic underperformance of value that we've had for years and years. That's starting to unwind.
The bottom line is we're in a bear market for bonds right now.
Its whole point is to get the economy growing faster.
We have to figure out, okay, how much overshooting is the Fed actually comfortable with?
The Fed's job has always been to deal with monetary policy, but we're hearing more and more dealing with income inequality.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Fed Decision Day from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro with equity futures negative about 0.1% on the S&P 500. It's the drumbeat into Powell in a few hours' time, Tom.
No, you're not looking at equity futures, John. You're just getting that out there front as the benchmark of the day. John, we've got to look at the 10-year yield, which certainly speaks to any announcement and any adjustment of the dots. This is possibly a chairman that's going to drive the yield higher this afternoon.
We've got the long end and the front end. The long end taking out the highs of Friday's session intraday, just north of 164 on a US 10-year. At the front end, it's about the dot plot, Tom. It's about the forecast and that median dot in 2023. Yeah. Does it start to signal that first rate hike?
For those away from this debate and the minutia of what's going to happen at 2 or 201 or 159 and that, it is, John, the shock of the median dot. We'll explain that through the simulcast today. But, you know, to me, John, it's a little bit overwrought. Am I right? They're going to do nothing, but those forecast adjustments will be microanalyzed.
It is all about the forecast. And, Lisa, those forecasts for growth, for unemployment, we're set to see big revisions in line with what we've seen maybe on the street over the last several weeks.
Yeah, which raises a question, what could make the market uncomfortable? Since everyone is expecting the Fed to raise some of their guidance for the forecast for economic growth, the key that I'm looking for is what guidance they will give around inflation rates that are within their range of comfort and those beyond it. In other words, 2.5%, 2.2%. What is running it hot and what is okay before they start to get a little nervous, John?
Will they forecast above target inflation? I'm going to be fascinated to see that summary of economic projections. Beyond all of this, Tom, it's got to be about that tap dance in the news conference for Chairman Powell. Just to borrow Lisa's word, uncomfortable. How uncomfortable is he with what he's seen at the long end? Because we have seen no sign of any discomfort whatsoever with 10-year yields approaching 160, 165.
Oh, he's going to go through it all. He's going to have some tough questions. I mean, I'll be honest, John. I think the ECB questions are a lot more rigorous and difficult than what he hears at the Fed special. But guys like Michael McKee in that press conference have to grill him just on the background. What are the PhDs thinking about this? Less what Chairman Powell's thinking, but much more what selected governors, what the Vice Chairman Claret is thinking. What's the background? I'm going to be watching that in the 2 o'clock hour.
We can talk about this through the morning as well. The difference between the ECB last week and the Federal Reserve later this afternoon. Tom, it'll be night and day. The forecast, the language, the expression, the tone will be completely different.
Let's run the circle here, John. What's everybody think GDP growth is right now? I'm going to go with 7%. Is that workable forward number? What's yours, John?
Consensus right now is still about 5.5. The numbers we hear increasingly is 6, 6.5, 7, maybe something north of that quarter on quarter in the fourth quarter. For Europe, Tom, maybe something in and around half of that, which is why the forecast not only will be very different at the Federal Reserve compared to the ECB, but the outlook for policy will be as well.
And Lisa, my head is spinning. That conversation we had with Amesh Adalja yesterday was world class. His criticism of AstraZeneca, and that debate's already moved forward as we begin the American morning.
To be clear, his criticism of governments in Europe for delaying any rollout of the AstraZeneca vaccine, and John, I do have to wonder how that slowdown affects global growth, let alone that in the Euro region.
He won't be the first, he isn't the first, and he won't be the last, that's for sure. Can we just sit on the number in America? 2.44 million doses per day is your daily average for vaccines
didn't know that.
in America.
When are you getting yours, John?
2.44 million, hopefully, Lisa, soon.
Let
me pushing my buttons here.
John,
early on in the
let me
program.
editorialize, okay? It is a disgrace, John. You can't get your first shot by Friday.
So,
I don't know what they're waiting for.
Not me, though.
Let me be clear here. Other states have started to make a move. The president's put a line in the sand of May 1st, and there's going to be a race here, a race to open up eligibility.
John, I want to start with this custom dot chart. You know this, John. Let's bring it up right now. Thanks to Hillary in London for really making this work. This is John pre-pandemic and where we are now. In pink, John, was what was long ago. And what's so important, guys, is over on the right side of that chart, we end up at the same outcome. John says who?
Do we? Exactly, Tom. Let's talk about that a little bit later this morning. Here's the price action this Wednesday morning. Good morning to you all. Counting it down to the Federal Reserve. Equity futures unchanged on the S&P, coming in just a couple of points on the S&P 500, still in and around all-time highs. In the bond market, 164. There it is, a little bit earlier on. In fact, around about 10, 15 minutes ago, we took out the intraday highs of Friday's session. And in the FX market, Lisa, stable. Euro dollar still with a 119 handle.
And honestly, the Fed's guidance today will have a big ramification potentially for the euro as well as for emerging market currencies, something I'm watching. Another thing I'm watching, 8:30 a.m., we're going to be getting housing starts and building permits for the month of February. Housing starts I'm actually less interested in. It'll be noisy because of the storms out south. Building permits, however, are running about 20% year over year higher now, and we're seeing them reach levels last seen during the mid-2000s. Read right ahead of that crash and burn of the mortgage market. We'll be taking a look at that. Meanwhile, today, those $1,400 stimulus checks are hitting people's bank accounts. This, I'm interested to see how much will directly go into meme stocks, how much are going to go into GameStop and AMC. We will be seeing that as well as potential ramifications for retail spending. And then 2 p.m., we've been talking a lot about the Fed rate decision. We'll be discussing all of the minutiae about what to look for. Another more technical aspect that I'm looking for is, will the Fed extend the exemption for certain bank capital ratios? This is a supplementary leverage ratio, which would allow banks to hang on to billions of dollars of treasuries they currently are holding on to, and potentially easing some of the stress that people are foreseeing in that market, John.
Maybe if Michael McKee can get a word in this news conference, that question might actually come up early on in the news conference. Let's turn straight to our first guest this morning. Eric Friedman joins us now, U.S. Bank Asset Management Chief Investment Officer. Let's start right here, Eric. The news conference with Chairman Powell, the summary of economic projections, the statement. Where's your focus?
Jonathan, our biggest focus is on what happens with that dot plot, and it seems like we're guessing out into the distant parts of the atmosphere. But to your point, this is about, will that shift come in? And for our clients, the biggest factor will be, will we see ongoing steepening in the back end of the curve? We have a lot of clients that are very conservative investors, and so they've traditionally owned a lot of fixed income. We've really been migrating those portfolios for the past couple of weeks, the past couple of months, to anticipate what we think will be a steepening, but not an indefinite steepening. So that dot plot and how much of a Texas two-step Chair Powell was forced to engage in during the press conference, those are the two focal points for us.
Eric Friedman, it's real simple. The chairman's got to get to after the press conference. The chairman's got to get to Thursday. Frankly, the chairman's got to get to Friday when Arkansas takes on mighty Colgate in the bracket. You know, we need a miracle out of Colgate to make it exciting. What's the miracle we need to see today from Chairman Powell?
The biggest miracle we need to see, Tom, is if the 10-year range can basically stay between, let's call it 1 and 1.25 to 175. If we see that reset to 1.5 and 2%, we don't think asset markets are prepared for that. And what I think that means in terms of guidance is that Chair Powell says, not only do I recognize what's happening in the yield curve, but there could be some actions if things get ahead of themselves with respect to price movement. So that's something that from a asset price, just across asset price perspective, reining in the top end of the range, if he does that, not explicitly, but through that Texas two-step, if you will, we think will be really important for markets to understand.
Why would he engage with Operation Twist? Because that's ultimately what you're talking about, right?
Yeah, it is, Lisa. I think the biggest thing would be the Fed can't let the 10-year get away from itself, or away from the Fed, I should say. It happened way back in the fall of 2007 when, again, that was the all-time highs at that point of the S&P, and the Fed unfortunately just let that 10-year drift above, and it got away from them. So I think that if you look at the cacophony of information we have to cite and siphon through, the biggest factor will be if the Fed hints that they may consider twist, if they may consider just stemming the back end of the curve move higher. That's something that mortgages care a lot about. That's something that equity investors care a lot about. So we wouldn't be surprised to see some, at least, prelude to those comments, if not explicit comments from Chair Powell.
Eric, we're working our way through the yield curve with you in real time, and we're talking about the flexibility at the long end. I'm trying to work out where that flexibility ends. So at the front end, you've got that pin to the floor for the next couple of years, T-bills all the way out to maybe the 2-year note. What do you think the belly of the curve starts to look like? What's that battle look like? How does that play out in the next few quarters?
Yeah, Jonathan, I think it's something that's critical for most investors. Whether you know it or not, you own a lot of duration in that 4 to 6 year time horizon. If you own a municipal fixed income in an index fund, or if you own a Barclays ag benchmark product, you own a lot of exposure that's exactly in the part of the crosshairs that you're talking about. So I think what the Fed is saying is that we're going to keep the front end pinned. We're going to try to really, I guess, close the range, if you will, on the back end of the curve. But the middle part of the curve, they're actually okay to see a little more steepening. And so I think what that means is that credit quality, in terms of things that we're looking at as investors, so non-agency mortgages, the middle part of the investment-grade corporate credit curve, those are areas that we think are relatively safe relative to, let's say, things like treasuries, where there could be a little more of a bias for steepening. So I think the Fed wants a slightly steeper curve, Jonathan, but not a curve that just goes indefinitely higher on the back end.
Eric, appreciate your time this morning, sir. Always great to catch up.
So
Eric Friedman, the US Bank Asset Management Chief Investment Officer. As we work our way through what we need to work through a little bit later on today, the statement comes out together with a summary of economic projections. Within that, you get the forecast for growth and the dot plot as well, Tom. And then you get the news conference a little bit later after that.
Got a lot of people to talk about this, John, but what's fascinating here, particularly for those not focused on the short term, is the colossal bets being made before a meeting. One of the joys of the street, John, is to enjoy losing money after making a bet before the Fed meeting. I have a little bit of experience in that.
It sounds like you do, Tom. Can you sort of tell us a little bit more about it?
Yeah, I
what you
would.
lost
I
money
was
on?
dumb as wood. Okay, that's the phrase you want.
Japanese
Make a banner
banks.
of that, guys. Tom was dumb as wood.
Tom was dumb as wood. Still haven't told us what the trade was.
Well, I can't remember the trade. It was the time of Greenspan or whatever. John, I know this needs translation for you. It's March Madness, and it's always great to see some of the Eastern schools slip into the final bracket. Mr. Friedman's Colgate will be represented in the bracket.
Did you do your bracket? We didn't even talk about that
No,
this
I
year.
have not done a bracket.
I didn't do it either.
You know, I just, I lose so bad, and this year with the pandemic, I've got, I mean, I'd have to go with Colgate.
I'm doing vaccination brackets.
John, it is so cold in Colgate. They have winter in the 4th of July.
We always
That's
appreciate
how cold
the
it is in
tangent, Tom.
Colgate.
Thank you. That was welcome. Coming up at 7 a.m., Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist. He'll join us a little bit later on this morning as we look at a bond market that takes out Friday's intraday high on a 10-year yield, 164, yields up 2 basis points. In the equity market, all-time highs on the S&P 500, just off them, 39.50 on the S&P. It is Fed Decision Day on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. The Fed is expected to stay the course at its second meeting of the year. Policymakers are all but certain to keep interest rates near zero. They're also to maintain the pace of asset purchases. The new quarterly forecast may give an indication of how many of Chairman Jerome Powell's colleagues are committed to his aggressive support of the economy. President Biden's tax plan will call for higher levies on corporations and wealthy Americans. It will also include relief for middle-class households, including those in the $110,000 a year income range. A White House economic advisor says the president also wants to encourage companies to increase domestic investment. Shootings at 3 massage parlors in and around Atlanta have left 8 people dead. Many were women of Asian descent. A 21-year-old man has been arrested. There's been a recent wave of attacks on Asian Americans that coincided with the spread of the coronavirus. And Samsung has become the latest tech giant to express concerns about chip shortages spreading beyond the auto industry. The South Korean company warns it is struggling from a serious imbalance in semiconductors globally. Samsung is one of the world's largest makers of chips and consumer electronics. It expects the crunch to affect its business next quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds of the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Teacher and a nurse who collectively make, $110,000 deserve relief. And what we've seen in the data is that families with that kind of profile have suffered. I mean, it's important to remember that according to the latest data, 1 in 7 American families reported going hungry. during the pandemic. There's a lot of need, and it's very widespread need.
That was Bharat Ramamurthy there, the National Economic Council Deputy Director. A really important conversation on how we define those in need at the moment in America. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Bramberts, I'm Jonathan Ferro. Here's the price action on Fed Decision Day. Equities near all-time highs. Your S&P 500 in and around 39.50, down almost 0.1% on the session. In the FX market, euro-dollar, stronger euro-dollar 119.11, and in the bond market, very briefly taking out the highs of Friday's session on a 10-year yield of just north of 164. Tom, 163.74, and up 2 basis points on the day.
Yeah, 2 basis points. John, I'm going to say a 163.74 sets up a Fed meeting with yields right near recovery highs.
I would go with that as well, Tom, and I think we have to ask the question to Chairman Powell, and it will be asked through this news conference. Do you still see this as a statement of confidence? Are you comfortable with what we've seen?
We have done well. Our team has really put together intelligence. Glenn Hubbard will join us from Columbia. Jan Hatzius with us later. Right now in Washington, Emily Wilkins with us, our government reporter. Emily, I've got to go to the Washington Post article where attorney generals from the states are looking at the 600 pages they have read, and they are basically saying, President Biden, you cannot lecture us on our desire to cut taxes. Is this something that's going to end up in the courts and in the legal process, or can this be argued out in a collegial way?
Well, if this is in reference to the upcoming tax moves that President Biden is looking to make as far as changing the tax code, I mean, number one, we're going to have to see exactly what is put out there. In regards to the $1.9 trillion legislation that's already come out, that's offering aid and funding to states and localities. A lot of those are parts, that's actually now the rubber's hitting the road, right? The bill has been signed.
Okay, so they're going to move, Emily, they're going to move the money to Republican states. Fine, I get that. But is the federal government, is President Biden saying, we're going to give you the money, but you can't cut taxes? That's the argument of X number of attorney generals.
I mean, at this point, the funding out there, I mean, it's the way that it was written was meant to sort of help these states and help individuals within these states as far as teachers, doctors, firefighters, sort of these public servant type groups. And so the end goal of the bill was to make sure that those individuals are not losing their jobs or being able to make sure they sort of continue in their roles without having to face any major cuts.
Meanwhile, we're looking ahead to the potential for infrastructure spending. And yesterday, Mitch McConnell was pretty vociferous when it comes to working with the Democrats, basically saying game off if they want to raise taxes. We're not going to participate. Basically, do the Democrats have enough momentum to go it alone without any Republicans? And the Republicans, to be clear, seem to be saying, we're not in on this.
Well, they're certainly going to try. I mean, definitely yesterday, it was huge for Minority Leader Mitch McConnell to come out and say that there was not going to be any sort of Republican interest in doing a tax plan, although I think that was kind of assumed given what we just saw from Republicans in 2017. But look, just because this part might need to pass through a budget reconciliation doesn't mean that there won't be other parts of the infrastructure bill that could be bipartisan. Remember, not everything can use that budget reconciliation process. To get some of this infrastructure done, they are going to need some Republican votes, but there are discussions about potentially breaking it up, doing a Democrat-only budget reconciliation, perhaps with a tax plan and other initiatives, and then doing something that's more bipartisan, where they can get those Republicans on board.
Emily, what have we heard from Senator Manchin on this front?
Senator Manchin has really encouraged President Biden as well as his colleagues to look for ways to work in bipartisanship here, to find ways to bring Republicans on board. At the same point, though, if you remember, one of the main things that Senator Manchin kind of said from the beginning is that he wants to be an ally for President Biden. He wants to see the Democratic initiatives pass. So I think he's going to be someone who's certainly going to push for certain things and push for some bipartisanship. But at the end of the day, I mean, he is a Democrat. He does caucus with the Democrats. He is supportive of the Democratic agenda.
So, Emily, do you see this as a piecemeal approach where you can get the bipartisan support, do it, or just a massive approach, one big mega bill again?
So what we are hearing discussing from lawmakers is sort of this dual approach. Do what you can do in a bipartisan manner, and then for the rest of it, put as much as you can in a Democrat-only budget reconciliation. And so what that will exactly look like remains to be seen. We are still very early on in the process of negotiations here. And so it's kind of unclear yet exactly where the bipartisanship might be. But transportation has usually historically been an issue that has been bipartisan and that there has been Republican and Democratic support on.
Emily, I want to tie this all together to have you characterize the mood right now in Washington, D.C. Yesterday, Senator Mitch McConnell came out and said that there would be a scorched earth Senate if the Democrats opted to reduce or potentially even cut the filibuster rule. How tense are things? How usual is this versus something a little bit out of the norm?
I think we're kind of coming to a huge turning point here where we are having a very serious debate about the future of the filibuster and what that would mean. I mean, to reform the filibuster to make it easier would allow a number of Democratic priorities to go through right now, yes. But as McConnell pointed out yesterday, when Republicans eventually get control of the Senate chamber, that means that they could push through all of their priorities. And it really sort of speaks to a potential future in which we're going to see Congress become a lot more effective, but also a lot more partisan. And so I think the serious debate going on around this, it kind of speaks to how partisan things have become in Washington, D.C., that we're seriously looking at getting rid of the filibuster, but it also could speak to sort of a different era of governing if you don't sort of have the Senate be the place where legislation really has to work hard and work long to pass.
The prospect of a 100-car pileup down in the Senate in Washington. Emily, thank you. Emily Wilkins of Bloomberg Government down in Washington, D.C. The focus, of course, today on monetary policy, but the reason we're talking so much about monetary policy is the effort that's been done down in D.C., Tom. A $1.9 trillion plan that would not have happened if we didn't have the events of Georgia earlier this year.
And you wonder, exactly. Georgia was certainly the tip point as well, and the GOP knows that. Greg Villiers in his morning note talking about new GOP unity, talking about gridlock, and you really wonder forward, John, does anything get done? It is to November of 2022, and you wonder, frankly, in the Bloomberg world, does that debate start at 2 p.m. this afternoon?
That debate has already started. And Lisa, I think for this Federal Reserve, they face a $1.9 trillion plan. They face calls for 6, 7, 8% GDP growth this year. And they've somehow got to convince people that rate hikes aren't coming anytime soon.
They've got to convince people that this time isn't different. We're not entering a new realm of inflation, even though we're undergoing one of the biggest social experiments in recent economic history, if you think about the helicopter money and the full spigots on all fronts.
That's what I find so interesting about the call out of Goldman Sachs and Jan Hatzius. Explosive GDP growth, unemployment plunging, but inflation dynamics do not change. Jan Hatzius will be joining this program in about 2 hours' time. You do not want to miss that live on TV and radio. In your market, as we count you down to a Fed decision and a Chairman Powell news conference, yields on a 10-year, 164 and up 2 basis points on the day. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide, this is Bloomberg Surveillance, and here is some of the price action for you. Equity futures coming in on the S&P 500 by barely 0.1%, down around about 2 points. The underperformance once again today is in the Russell. The Russell down by 0.5% after getting smacked around yesterday by 1.7. Granted, Tom, still up by 17.5% year to date. But here's the story for me. Have growth expectations started to peak? Growth certainly hasn't. We'll see that in a couple of quarters' time. But have expectations for growth started to peak? And what does that mean for the cyclical trade? Morgan Stanley, first out the gate, Mike Wilson started to push back against the small caps call that he made in April of last year. Yeah. Maybe time to reduce. And Tom, that was the struggle yesterday. And that's why you see the underperformance again this morning, down by about 0.5%.
Well, I saw that on your other property as you had Mr. Wilson on. And I guess we're going to have a lot of pontification on this, John. But I'm sorry, 7-8% growth is just what it is. John Herman at MUFG out at a risk to 10% year-over-year growth.
And then what? What in 22?
Then
what in 23? Yeah. And what does it mean for the growth versus value trade? Switch up the board and get to the bond market. This is the ballet of a little bit later. 2s, 10s, and 30s. Yields up on a 10-year. 164.44 is your new intraday post-pandemic high this morning, taking out the highs of Friday. Right now, 163.92 and up 2 basis points on the day. So this is what's going to happen a little bit later. Long end, a lot of people think there's a lot of flexibility because Chairman Powell has offered that. He's called it a statement of confidence to see yields higher. Is that still the view from the Federal Reserve Chairman at 164, on 10s at 240, on 30s? At the front end, this is where the rate hike ballet starts to play out a little bit more so. 2s out to the belly. What happens with the dot plot? Goldman, just one of the banks out there looking for that dot plot in 23 to start to signal that first rate hike. We'll get to that in just a moment. Finish on this, though. One chairman's statement of confidence is another chairman's what? Undue tightening. We've talked about that a lot over the last couple of weeks, and here's the story for you. Year to date, a US 10-year up 72 basis points. Okay, the outlook's brighter. In Germany, your 10-year yield still negative 32 basis points, but on the year, up 25 basis points. Undue tightening. In Australia, your 10-year up 75 basis points. Undue tightening. And the key for central bankers today, Tom, it won't just be the Federal Reserve central bankers that get together and focus on this decision today. It's going to be the ECB. It's going to be the RBA. It's going to be central bankers worldwide watching this decision because it will have consequences for them too.
And you saw the Merkel headline here across Bloomberg, John, the growth disparity, the growth expectations disparity between the U.S. and Germany has just simply never been wider.
No, and we've talked about that, and Lisa and I have gone back and forth on it. You just wonder today, Tom, I think we can just assume today will really underline and re-emphasize the fact that the outlook for America is radically different compared to the outlook for Europe. And it's not just the vaccination rollout, it's the fiscal impulse as well, or $1.9 trillion of it in the last couple of months.
UniCredit of Italy folks are really talking about the importance of what we're going to see at 2 p.m. this afternoon. We decided a number of days ago that our team would go out and get the best voices we can. Jan Hatzius will join us here in a bit as we move forward to the Fed show at 2 p.m. this afternoon. We start strong, or strongest, with Glenn Hubbard of Columbia University. To say his professor of economics, former Council of Economic Advisors chairman, doesn't do credit to what he did at the Columbia Business School, is his tenure there as well. He is the most articulate supply-side conservative out there, and we start strong with Glenn Hubbard. Dean Hubbard, I'm thrilled to have you on the show to talk about the assumption that growth will save us. Your laureate colleague, Joe Stiglitz, would say, over time, over the years, we can grow our way out of a 5 standard deviation deficit. Does that math work?
Well, it really doesn't for 2 reasons. We will grow very rapidly this year, 6+%. That's a challenge for the Fed to change its own forecast. Going forward, with the fiscal impulse reversed, we're back to more normal rates of growth. Second point, a lot of our problems in fiscal policy are in programs that just grow on autopilot, so-called entitlement programs. Growth alone doesn't save you there. We are going to have some kind of fiscal consolidation in spending, in taxes, or dare I say it, inflation.
Glenn Hubbard, I remember in August, Thursday of 2007, where we all looked at 4 standard deviation, 3-month T-bill, 4 standard deviation LIBOR. We're way out over that. We're out to a medical chart of movement on our fiscal policy. Does it signal crisis that we're out near 6 standard deviations on deficit to GDP?
I don't think it signals a crisis, but I think it signals a warning. It's not a crisis to the extent this is largely one-time borrowing, although even there, it needs to be smart, which I can't entirely say for what we've just done. Going forward, though, we have to have a more sustainable fiscal policy, and that requires taking a hard look at promises we're making. For example, many promises being made in the American Rescue Plan Act aren't paid for going forward. We have to ask, what are we going to do about it?
All right. In a recent Washington Post article that you wrote with Alan Blinder, you said there are good reasons for running large deficits now, as long as the spending is well targeted. I get the sense that you have some criticisms about what was just passed, the $1.9 trillion stimulus. What in there is targeted, do you think is appropriate, and what do you think is not?
Well, I think a smaller bill probably would have done the trick. And by the trick, I mean making sure we've shored up unemployment insurance, modest aid to states, aid to businesses for continuity. Those sorts of things make sense to me. Writing checks to people who didn't lose their jobs and whose wages didn't go down is hardly targeting, and it risks ruining firepower for later. And of course, part of what's in the bill has little to do with the pandemic and is a set of social policies. And they may be good, they may be bad, but they're not really part of a stimulus bill.
Limiting firepower for later, are you talking about possibly the Fed's hand being forced with higher inflation than expected? Or are you talking about it sucking the oxygen out of Washington, D.C. for infrastructure spending and other initiatives?
I'm talking more the latter. I don't expect the Fed, there will be a transitory burst in inflation. I don't expect the Fed to confront an inflation crisis as a result of this. I think it's a warning, and communication is important. But I do think it puts at risk other fiscal agendas President Biden might have, whether it's physical infrastructure, whether it's training initiatives to help workers prepare for a new economy. All of that could be put at risk because of overdoing it here.
Glenn, pre-pandemic, we lived in a world that was very, very shallow growth, and it was a very extended cycle as well. Low trend growth, low inflation, certainly not the kind of inflation to worry about. Is there anything in this bill that really disrupts the existing trend before the pandemic, coming out of the pandemic?
I don't think so much about this bill, but I do think we could be on the verge of much better productivity growth going forward, which would presage a better growth rate. The risk in this bill and what follows on is that a combination of excessive spending in some areas and tax increases to pay for it limit that growth. I think that's the risk we're going to hear about in the next couple of years.
The reason I asked this, Glenn, is because the last cycle was so long and so shallow. And I'm trying to understand, as we move through this one really quickly, particularly in financial markets, and if we see that snap back just as fast, whether we need to be prepared for short cycles again and maybe look past the history of the last 10 years and look to what came before.
Well, I think a lot will depend on how policy responses develop. So after the global financial crisis, we did have a fairly sluggish and eventually large policy response, but it didn't really reset business people's expectations. It was a fairly anti-business regulatory and tax agenda. And so the question is, will we do that again? I hope not, and I don't necessarily think so. I think President Biden has a somewhat different agenda, but we'll have to see.
Glenn Hubbard, can we close the inequality that we have? Can we close the pandemic-induced inequality given modern technology? This is something you did at the business school. You led on this for years. We completely understand not understand the technological impulse right now. Are we asking for too much from our authorities to close the inequality gap?
No, I don't think we are. I don't think we can, quote, close it, but I think we can start by asking a big question. Given the technological changes, you put it, and also globalization, have disadvantaged some kinds of workers while they've advantaged most of the rest of us, what can we do about that? If I were President Biden thinking about, quote, infrastructure, I would think about preparing people. So that would be focusing on community colleges, focusing on distressed communities in a meaningful way. That, to me, is preparation to compete. That's what Adam Smith calls.
All right, Glenn, just to wrap this all together, the underlying fear in markets, the underlying debate is really on inflation. And you touched on this earlier where you said that you do see this more as a transitory phase, or at least that's how the Fed will look at it. What would you see, or what would you have to see to shift your opinion to say this time really is different in terms of a new inflationary regime where suddenly prices start going up at a substantially faster clip for a prolonged period?
Well, I think exactly as you said, you'd need to see working its way through the system, the sustained price increases at all levels and wage pressures to follow it. What I'm more worried about in the near term is a spillover into financial froth, into markets, more than goods prices and services prices getting out of hand.
Glenn, always great to catch up, sir. Appreciate your time. Thanks for being with us. Glenn Hubbard there, the former Council of Economic Advisors Chairman and, of course, Columbia University Professor of Economics. That final point there from Glenn, I think is really important, Tom, because Mohamed Al-Arian, who often joins us on Bloomberg TV and radio, has also made that very same point, that his biggest concern is not about runaway inflation, it's about financial stability overwhelming the recovery in the year to come.
Well, the financial stability question is easy, and you look at the vanilla spread. I just put it up here. Lisa, I believe, mentioned it at the top of the show. The 2's 10, John, out to 148, rounded up to 149 basis points. That's sort of normal to see, but the financial stability issue is much thicker than just the vanilla spread. John, it's down at the short end of the curve, and frankly, is the shock of the system to something we've never experienced before, which is 7, 8, 9% growth. We need to figure out if we can manage that.
Explosive growth, and Lisa, may be accompanied by low inflation through 22, through 23 after an initial pop and the base effects kick in, and the Fed stays on hold. What happens to financial conditions and financial stability in that world? I think you can take a guess.
Well, people are talking about inflation. They're talking about consumer prices. They're not talking about asset price inflation. And at what point does that catch up with the economy? No, in all seriousness, this does bleed into the real world when it talks to housing and at what kind of mobility people have because house prices have gotten so high. You know, you do wonder how much does this exacerbate inequality and, frankly, lower overall growth, John? It's just, to me, and at what point does it pop?
To be fair to Lisa, Tom, we took her there.
We did.
That's where the conversation went.
It's okay.
And I totally agree. The Federal Reserve, in many ways, many people will say, has exacerbated inequality, and yet they're set to keep rates unchanged to try and close the gap, or at least have this government close the gap, Tom.
It's the asset price pendulum of doom.
Is that what it's called?
That's what it's called.
Okay. Coming up, Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine, as we have a stellar vaccine rollout in the United States of America, 2.4 million on average. This is Bloomberg.
With the first the growth forecast and are warning about the recovery. They say Europe's economy will expand by 3.1% this year, down from November's 3.7% forecast. They also say the recovery could be jeopardized by a jump in coronavirus infections. Fed Chairman Jerome Powell has promised to maintain aggressive support of the U.S. economy. The central bank's quarterly forecasts will show how many of his colleagues share his commitment. Those forecasts are out today at 2 p.m. New York time. Fed policymakers are all but certain to hold interest rates near zero. Senate Minority Leader Mitch McConnell says there's no chance Republicans would support tax hikes to pay for President Biden's infrastructure plan. McConnell predicts that Democrats will use the process known as reconciliation to get a tax hike through with a simple majority. That was the same process used to win passage of the president's stimulus package. BMW is predicting a better-than-expected increase in profits this year. The German automaker is also joining rivals in targeting a steep rise in electric vehicle sales by the end of the decade. BMW wants about half of its total sales to be electric by then. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
we are still firmly convinced that the benefits of the AstraZeneca vaccine in preventing COVID-19 with its associated risk of hospitalization and death outweigh the risk of these side effects.
As underlined by the European Medicines Agency today, the number of such events overall in vaccinated people seems not to be higher than in the general population.
This Oxford AstraZeneca vaccine is safe and that we should listen to the regulators.
That was Emma Cook, the EMA Executive Director, Stella Kyriakidis, the EU Health Commissioner, and Matt Hancock, the UK Health Secretary. And it's the same old story in Europe. The Europeans cannot get on the same page, and this time it's deadly. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Here's the price action. Your equity market looks like this on the S&P, 39.52. On the NASDAQ, we come in as well, just a little bit. On the Russell, that's where you see your outperformance this morning, underperformance rather, after underperforming yesterday as well. In the bond market, there's the number though, 164, 164.44 earlier on this morning, taking out the intraday high of Friday's session. That's a new post-pandemic high, so to speak. And in the FX market, euro dollar 119.12. And later today, when we talk about that Fed, we'll talk repeatedly about the distinction, Tom, between what is happening in Europe on the euro side and what is happening in America. And here's the number in America. 2.44 million doses per day on average over the last 7 days.
And you see in airlines as well with 1, 2, 3, 4, 5 straight days, 1 million, 1.2 million plus in travel. John, I'm going to call it all quiet on the FOMC front, but I'm going to make clear, John, that what we see here is into the meeting, not the headlines, but how the forecasts will move. I think that can't be repeated enough.
Couldn't agree more, Tom. How the forecasts move, huge revisions. How the dot plot shifts according to those forecasts. That's going to be the kicker. That's the story.
We had an historic conversation yesterday with Amesh Adalja. He was scathing on the European vaccine response. We go American today with Lauren Sauer, with John Hopkins as well, Associate Professor of Emergency Medicine. Lauren, I see a lot of percolation that as we open up society, we may quote-unquote plateau in our statistics. Is that fear valid?
I think that fear is valid. I think the key is to open up safely. Exactly, those words are so important, right? We still want to use all of those tools that we've been developing over the last year in fighting this pandemic. So when we're reopening businesses, can we do it safely with good practices about distancing between patrons? Can we continue to use masks? Can we continue to reinforce those face covering requirements, even if we're reopening bars, restaurants, other businesses in society, and especially in schools?
Yesterday, Mayor de Blasio of New York City came out and said it's really unfortunate that cities aren't receiving vaccines directly from the federal government, that it has to go through the state. Yes, this has to do with the tiff between Andrew Cuomo and Mayor de Blasio, and yet this also does highlight a key question. Should cities be getting the vaccine directly? Should we be getting a better distribution mechanism from the federal government?
Yeah, I think this is a challenge, not just with the vaccine distribution. We saw it with testing. We've seen it with a lot of the other healthcare activities associated with this pandemic and healthcare more broadly in the U.S. We do not have a federal system for healthcare. We have a disaggregated healthcare system. It makes national strategies for anything really challenging. And we're seeing that play out in real time. And it'll only be exacerbated in an emergency, right? Because you have to make rapid decisions. You have to rapidly distribute, but you still have to use these existing chains, these existing pipelines. And so if you want to get vaccine into the hands of the community that has the greatest need and can and knows how to work with that community to access them, absolutely go through these processes. But the way our healthcare system is set up, there are these sort of chains and pipelines that slow things down.
Lauren, let's talk about slowing things down right now. The president says May 1st to open up eligibility to all adults. Here's what Montana's got to say April 1st. Ohio, similar story, end of the month. Every other state that watches this happen, and I can tell you living here in New York, when I look to Montana at the end of the month and Ohio and start to see eligibility wide open for 16 plus, I'm going to be asking the governor here in New York the same thing everybody will be asking. Why can't we do the same thing? What is going on? What is stopping places like New York and others just to do the same thing now? Open up eligibility.
Yeah, I think there's a couple challenges, right? So part of it is the access. How do you make sure that you're getting to those most vulnerable communities. And that goes back to what we were just talking about. Do these states that are moving up that timeline, do they know how to access their vulnerable populations quicker, or are they just moving on because they have sort of not been able to access those communities and they want to get vaccine more broadly? These disparate decisions about how we administer vaccine and how we interpret the ACIP guidelines are what's leading to these changing dates depending on where you are. So it also can lead to sort of vaccine shopping, which I think we're seeing a little bit in places, especially in more well-to-do places where people have better access because they have multiple residencies or they meet requirements in one area and not in another, and they can relocate to access those vaccines. So I think that May 1st deadline or timeline it's exciting and it's reasonable, and I think we can get there, but we really have to focus on making sure that in communities where access is hard or where we're not getting at those most vulnerable, hard to reach communities and populations, that's where we target to make sure that we are protecting those who need that safety net so much more.
Lauren, in some ways, these are details, especially when you look at the scene in Europe, where they're struggling to get even a relatively significant proportion of the population vaccinated. Angela Merkel's advisor said today that the biggest economic risk is a third wave of the virus. In the United States, based on the vaccination schedule and that May 1st pledge, is the threat of a third wave off the table?
I wouldn't say it's off the table. I think we are definitely in a better place, and some would say we're in a much better place than we thought we would be, and especially as we started seeing the B.1.1.7 variant enter into the U.S. We're still seeing increase in cases in that variant, and I think there's a lot of questions about what will happen in the numbers as these rapid reopenings change in places like Texas, for example. But right now, the numbers are still looking good, and I think the key is to hold on to those measures that we have worked so hard to implement that we know work as we expand vaccination coverage. We're doing a great job, I think, in getting the numbers of vaccinees up. And now the key is to do those targeted areas that have lower vaccination rates to keep those overall numbers across the country down.
Lauren, always appreciate your time. Thanks for being with us early this morning. Lauren Sauer there, Johns Hopkins Associate Professor of Emergency Medicine. Just going through some of the themes that dominate the conversation around the vaccine rollout. Right now, Tom, the number's terrific. Let me just repeat it. 2.44 million doses per day on average over the last 7 days in America. But the pushback is imminent. When you start to see other states open up eligibility the way Ohio and Montana have announced they will do in the next 24 hours, big questions will be asked of governors across this country. Why aren't you doing the same? Why do I need to wait?
Yeah, well, why do they need to wait? I'm frankly with you, John, as I thought Lauren, of course, has to, as an institutional officer, be diplomatic there. But I'll be honest, John, I'm with you on this. I think it's less about that. It's far more about people just simply don't want to take the vaccine.
A lot is going to change.
Let younger people
take it. Couldn't agree more. A lot is going to change in the next couple of weeks, that's for sure. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. We are counting you down to a Fed decision and Chairman Powell news conference with 164 on the screen on 10s and close to all-time highs on the S&P 500. From New York City this morning, good morning. This is Bloomberg.
will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be, as you